Good evening, member. Namaste. I welcome you all for the study circle meeting, recent development in ITR form and important IT updates applicable for assessment year 25-26. And to discuss on the topic, we have with us CA Karthik Shastry with us, and I request Sri Raksha, Managing Committee Member of Bangalore branch, to kindly escort the speaker onto dais and welcome with the floral bouquet. Thank you, Sri Raksha. I have privilege in introducing CA Karthik Shastry. CA Karthik Shastry is a young chartered accountant based in Bangalore, qualified in 2021 with specialized expertise in direct taxation. He provides end-to-end tax services to a wide-ranging clientele, including individuals, firms, corporations, charitable trusts, and multinational companies. In addition to being a CA, Karthik is currently pursuing CS professional level and CMA final level and has secured All India 24th rank in CS executive examination conducted by ICSI in 2021. Karthik began his professional journey with Dhruva Advisory in 2021, gaining valuable experience in corporate taxation, litigation support and client representation before appellate authority in 2021. In 2021, driven by his entrepreneurial spirit, he established his own firm, R. Karthik and Company, which offers specialized in tax advisory, compliances and litigation services across a variety of industries. Demonstrating his continued commitment to the field, Karthik currently serves a member of Direct Tax Committee of Karnataka State Chartered Accountant Association for the year 2024-25. With this brief introduction, I present before you CA Karthik Shastry. Over to you, sir.
Hello, Namaskara. Good evening to everybody who has come here. And again, thanks to Bangalore branch for organizing this particular seminar. We had a similar session last year as well, and I've been honored to address the same audience again this year as well, while we just started with the ITR season. All of us are aware that as of now, we are finding only ITR 1 and 4. That too, I think, with most of the information just being loaded in the portal, I think we are still waiting for the full-fledged operation of the portal, and then maybe we'll proceed with the filings of all the returns. So, what is there on the table for discussion today? We'll first briefly look into what is the revised due date structure for this particular assessment year, and then we'll also look into a few important ITR validation rules. Of course, as of now, we have received validation rules only for ITR 1 and 4, 2, 3, 5 is still awaited. But I have picked up only a few important validation rules so that it will be easy for us to keep those in mind and get the returns processed seamlessly. And the main topic for discussion today is the changes that have been brought up in the ITR forms by the CBDT and corresponding changes that have been brought in the Finance Act 2024 and a few of the amendments that have come up in this year's budget as well. Insofar as it concerns only to the filing that is there for assessment year 25-26. We will not touch upon other administrative changes. We will touch upon those changes which affect ITR filing for our clients. And lastly, we will discuss few important points which I think is very important for all of us to keep in mind while we are preparing the return filing. So, firstly, all the due dates are still intact, just that 31st July has become 15th of September. So I think hope everyone is clear with that. As of now, we are still waiting for utilities for ITR 2, 3, 5, and the utilities are out only for ITR 1 and 4. Of course, the softwares are also updated and we are filing the returns. As of now, I think the statistics which I am showing you is taken directly from the portal, income tax e-filing portal. As on 26th June, we had close to 62 lakh returns filed for current assessment year, out of which mere 93,000 returns are processed. There is a speculation that the department got embarrassed with this particular number, and as on date, if you remove the statistics from the portal. They have given only the number of returns filed and the number of returns processed is just vanished. So the processing of return is just begun, and the processing of return will take time, quite some time this year as compared to what it was before. So with this particular brief statistic, I would like to start today's session by asking just one question. What is the role of a chartered accountant in filing the returns of their clients? Is our responsibility to get the returns filed within time? Although majority of the clients come to us only at the end of the season, last 1 week is where majority of the return gets filed in every other office. Is our responsibility restricted to just filing the return, or is it an extended responsibility to get the return processed properly from CPC? Or going one step further, it is a responsibility of us to get the scrutiny as well done seamlessly for the returns that we file. Because invariably, any client that comes to any office, they think that if we give all the files to the CA, they will take care of our file end to end. Be it filing the return, be it getting the refunds processed, be it getting the intimation collected properly from CPC, or in a few cases the clients are even expecting that even when they get a 143(2) notice, we have to handle the case just because we have filed the return in that particular assessment year. So is the role of a chartered accountant extended so much that we have to take care of the assessment of the clients as well, along with filing the returns of income? Of course, we as professionals, we have a straightforward answer. We have our engagement in place only for filing the return of income. That too, filing of return of income is the primary responsibility of the assessee. The CA is only assisting in filing the returns. End of the day, OTPs of client is what is put in the income tax form, and it is as good as the client has filed the return themselves. What are we doing? We are just assisting them in filling up the right schedules, in filling up the right amounts, as well as rightfully guiding them in payment of taxes. It's not just filling up the right schedules or tabs in the portal, it's also our responsibility to guide them as to what is their actual responsibility, what is their actual liability of tax. If they are eligible for a refund, yes, well and good, we can get a refund credited to their accounts. But however, we cannot take in such clients who come to us only for refunds. This is the important point that I wanted to stress upon, because more or less for corporates or assessees that are charitable trusts, they have some sort of a system in place, and they have people in their offices who understand the process of ITR filing, the process of tax, liability, etc. But the ones that we file returns for in July, this year of course it will be September, majority of them are salaried individuals and senior citizens who are earning pension incomes or maybe interest income from various sources, and primarily ITR 1 to 4 is what I mean to say. So somewhere or the other, their intention, one part of the intention of coming to a chartered accountant is to see whether they have paid more taxes and whether they can claim some sort of a refund. So that is one part of the intention with which any assessee that comes to us in July will have. So I want to show one of the examples which I had shown last year as well in the same session. So this is obviously it's not an official document that is circulated. This is speculation that is circulated in WhatsApp. So this assessee, whoever has filed the return, they have put in gross salary of around 22 lakhs. And the assessee has opted for new tax regime wherein the scope of deductions and exemptions is very less. We have very less scope for availing exemptions. Only in old tax regime we have the option of availing all the exemptions available. So the assessee is well aware that the new tax regime doesn't offer exemption under 1013A, doesn't offer exemption under 10 clause 5, doesn't offer ATC deductions. So having aware of all the non-availability of exemptions under new tax regime, the assessee has entered nature of exempt allowances as any other and has entered all those exemptions in this particular schedule. So any other exemption is still available because only 1013A and 10.5 is not available within section 10 of salary. Other things are still available. So So the assessee has entered all these other deductions which they would have otherwise availed in old tax regime by choosing any other exempt allowances. And they have claimed some sort of refund. Of course, this is done purely to get refund. The TDS would have been made on the entire part of salary. Just because of entering these particular exemptions, the assessee has availed the refund. The assessee community will not know the consequences. But we as professionals, we as part of a CA community, we will know what are the consequences. And one of the consequences include this particular notice. Invariably, every second office, CA office in the country has received 143.2 notice for any of their clients in the last 1 week. There has been a mass discharge of 143.2 notices by National Faceless Assessment Center, and most of the CA offices have received at least one client where they have got this 143 notice. Why are we getting these notices? Because of availing bogus exemptions, because of having invariably high cash deposits vis-a-vis the income that is offered in the return, extremely high expenditure and payment towards credit card or foreign travel as compared to what income is offered in the income tax return. So all these consequences will have only one result, which is a 143.2 notice issued by the NFAC. Unofficial source, NDTV has reported this particular point, that close to 1.65 lakh assessees have received 143.2 notices over the past 1 week, and major reasons are noted as unusual cash deposits, unexplained substantial bank credits. My income is just 6 lakhs, 7 lakhs, but I have 3 crore credits in my bank account. It is obviously suspicious, and gone are the days when we used to think just because we file a return, our responsibility is over. The department knows everything. It so happened in my own office that last year I had a client who came to me with a 29 lakh salary, around 4.5 lakh of TDS. And the moment he contacted me, it was the first time that I interacted with him. The moment he contacted me, he said, "You have to give me 3 lakh rupees refund, minimum. If you can give me the entire refund, it's fine, it's well and good. But I need 3 lakh rupees refund as a minimum refund." Of course, straight away I denied the client. I told him the consequences, and I informed him about what happens if the department finds out. Assessee will not know 270A. We will know 270A. Tomorrow, if the department finds out that this is a bogus claim, because the assessee is aware that the new regime does not allow you to take exemptions, despite which you have gone ahead and take so many exemptions and deductions, which is a straight misrepresentation of facts, which will have one result, which is underreporting as a consequence of misreporting under 270A. Penalty is as high as 200% of the tax liability. All these information the assessees will not know, but we as professionals will know. So what I mean to say in this particular aspect is, let us go one step forward in educating the clients, not just filing their returns, also to educate them as to why you should not claim bogus deductions, why you should maintain proper documentation. Whenever you invest in a PPF account, don't just invest, take a statement. When you are paying for a life insurance premium, just don't pay and leave it. You will say, oh, Gmail communication is there, whenever I want I can take it. When once we come to the ITR changes, we will realize that even when we are paying the life insurance premium, how important it is to download the premium receipt and save it in the folders. So this is how we as professionals can help, because assessees will not sit and attend any CPE seminar to know all these intricacies. We as professionals are having this opportunity to learn and also to educate the clients. So with this particular backdrop, let us start the changes in ITR. Before the changes in ITR, I wanted to just highlight few validation rules that have come up this year. Validation rules they have a category A, B, C, D categories of validation. Based on that, the CPC will, if it is a category A validation, CPC will not take the return itself, it will not be accepted. If it's a category B, the return will be accepted, but with a potential 139.9 notice. So there are A, B, C, D categories. I have picked up only few important ones. 2 and 3 we are still awaited. 1 and 4 we have received the validation rules for this year. So linking of Aadhaar and PAN is mandatory now. Gone are the days when we were getting extension upon extension, 3 months extension, 6 months extension. Doesn't work now. Quoting of Aadhaar number is is made mandatory, without which the return will not be accepted on the portal itself. It will be a validation error. ITR 1 and 4 cannot be filed if the assessee has a special rate of income. If the assessee has a special income which has a special rate of tax. So basically, schedule SI is not applicable in ITR 1 and 4. If the assessee has any of the special incomes, you should not file ITR 1 and 4. The rightful form will be ITR 2 and 3 as the case may be. And last but the most important part is that if the assessee has deduction under section 194Q, 194C, 194R and 194N. If the assessee has deduction under any of these 4 sections, assessee cannot file ITR 1. This is a validation rule which we may miss out because it's in the category C validation, wherein the return will get uploaded. We'll not know whether this is a validation error or not. But after a few days, when the return starts to get processed, we'll get a 139.9 defect. Last year, we have received this for a lot of assessees across the country, wherein there is a 194C entry in the TDS schedule, and the assessee has filed it under other sources and filed ITR 1. So in all those cases, the returns have been made defective, although there is no specific provision in the law that if you have 194C, you should not show it under other sources. Because if it is not a routine job for you, you may not show it as a PGBP. You can still show it under income from other sources. There is no restriction as far as the law is concerned. But adhering to the validation rules, I would suggest that if the assessee has deduction under TDS under any of these 4 sections, please avoid filing ITR 1. You may still file ITR 4 by showing it under PGBP, showing it under presumptive. But if you do not wish to show it under presumptive, you can maybe file ITR 2 by showing it as income from other sources. So this is a very important validation rule that everybody needs to keep in mind. Coming to important changes, I have highlighted all the changes except for capital gains, because capital gains we have a lot of changes to be discussed. Last year's budget was a shock for capital gains. So I have kept it aside and we'll discuss at the end. But apart from capital gains, I have made note of the important changes that have come up in the ITR forms. It's needless to say that there is no major structural change or a major overhaul of ITR forms. It's more or less the same. The changes are either there is a slightly detailed disclosure in a few schedules, or the changes have been brought up merely because of some changes that have happened in the law. So apart from these 2 reasons, there is no major change that has happened in the ITR forms for current year. So ITR 1 and 4 have been updated. Of course, we discussed this in the validation rules as well. We can no longer enter just Aadhaar enrollment ID. We have to enter the exact Aadhaar number before we file the income tax return. Taxpayers are required to mention the specific section. This is a very, very important amendment in the ITR form. All these years, we had 26 years. If we are using any software like Winman or SAG or something like that, we were able to extract the data along with the section numbers under which the TDS was made. But if the return was filed in the utility or in the online portal, we were just getting the information of TAN and amount of TDS made against that particular TAN. There was no column for section under which TDS is made. But from this year, there is a change in the ITR form. All these changes, I'll just show how it is reflecting in the ITR form. I've just taken snapshots of that. But as of now, let's just discuss the changes. So, what has happened? We have to enter the section under which the TDS is made and against which what is the corresponding income that I have offered. Suppose there is a deduction wherein a same party has deducted under one section and another section. Suppose there is a section A and section B. Now that entry will be repeated again. So that in the first row it will show under section A how much is the tax deduction from that TAN. In the next row it will show how much is the deduction under section B from that particular TAN. So for both different sections you have to mention what is the corresponding income that you have offered in under which head of income that you have offered. So it's a very major change. Of course, if somebody is using softwares already, this is something which we have been doing from a long time. Even when we are using Winman or something, there will be a column at the end, right end corner, which says section only for reference. But for reference will be removed now because even the schedule requires section to be mentioned. Taxpayers now can report long-term capital gains up to 1.25 lakhs in 1 and 4 itself. So ITR 1 and 4, usually we did not have the schedule to report capital gains, but for this assessment year, we can report capital gains provided it is a long-term capital gain under 112A and the total capital gain amount is less than 1,25,000. Because up to 1,25,000 there won't be any tax to be paid, and therefore there won't be a requirement of schedule SI reporting of this particular capital gain, and that's why they have introduced this particular column in ITR 1 and 4 itself. Under income from other sources, we have now the option of choosing interest from savings, interest from deposit. The change that has come up is that even for dividend, we used to report quarterly dividend accrual in ITR 2 and 3. But that quarterly accrual is now mandatory in ITR 1 and 4 also. So ITR 1 and 4 we used to report the total dividend earned in the particular year. There was no bifurcation of quarterly dividend accrual. But in ITR 1 and 4, now there is an option for reporting quarterly accrual of dividend. This is only for the purpose of calculation of 234C interest. So which is why they have given this particular quarterly breakup. So details of all bank accounts, now we have the option to choose which bank account we need refunding. All these years we were mentioning the bank account which we want refunding in the first row. First row used to usually mention which account you want refunding, but now we can mention any number of accounts in any order, and also we can choose any number of accounts. So we can maybe choose bank 2, 4 and 6. And which bank account is validated, the CPC itself will choose which account to credit the refund, and the refund will be credited accordingly. Schedule A is a very major change. We were reporting personal assets and liabilities of assessees in ITR 2 and 3 where total income was more than 50 lakh rupees. But from this year, the 50 lakh limit has been amended to 1 crore rupees. So up to 1 crore rupees, this is a total income. So total income means total income on which tax is calculated, not the gross total income. So if the total income is more than 1 crore, we need to report Schedule AL, otherwise Schedule AL is not mandatory. Few disclosure requirements which are as a part of changes that have come up in the law. Detailed disclosure with respect to opting out of new regime. So AY 24-25 was the first year in which new tax regime was made mandatory, or the default tax regime rather. So if you are opting out of new tax regime, this year there is a detailed disclosure in forms ITR 1 and 2. There is nothing but you just have to say whether you had opted for new tax regime earlier and are you opting it out now. Of course, for ITR 3 and 4 there is an additional requirement of giving reference to Form 10 IEA, where you had opted out of new tax regime by filing 10 IEA. If you want to opt in, again you have to give acknowledgement of 10 IEA to withdraw the option under 115 BAC 6 and come back to 115 BAC 1A, which is the new tax regime. Presumptive taxation, there is a new section 44 BBC. It is applicable for non-residents carrying out cruise ship operations. The presumptive tax rate is kept at 20%. So this is being added in the list of presumptive sections in ITR. And it's the same thing, the new tax regime is being made default. So the corresponding disclosures are being made mandatory in ITR 1 and 2 also. Standard deduction is updated now. Under old regime, section 16(1)(a), we still have 50,000. But if we opt for new tax regime, the standard deduction gets enhanced to 75,000. And accordingly, the forms have been modified to see whether the assessee has opted for old regime or new regime. Based on that, 50 or 70 will be chosen automatically. Agnivir corpus fund deduction was not there in ITR 1 before. It was there only in ITR 2, 3 and 4. Now it has been reintroduced in ITR 1. So it's a small change. So whatever, these are the only major changes with respect to the form is concerned. Of course, there are few more changes with respect to detailed disclosure under deductions. We'll discuss all that little later. So whatever we discussed till now, I just wanted to show it how it would look in the ITR form. So this is the TDS section wherein the yellow highlighted column is the new column that is inserted, section under which TDS is selected. And you can see in ITR 1 and 4 that it is eligible to, this can be filed by an assessee having long-term capital gain under 112A up to 1,25,000. This is about that dividend accrual, quarterly dividend accrual. You will get a drop-down box basically to choose dividend, and once you choose dividend, quarterly breakup will be opened on the portal, and you can just enter up to 15th June and so on.
Sir,
Yes.
in case of final dividend, the date of accrual should be made as per the recommendation by the board meeting or approval by the shareholder. Which quarter?
In my view, it should be shareholders, because shareholders are the ultimate ones who will approve the
So
dividend.
the accrual should be made in the second.
Yes, yes.
After the AGM.
Yes.
What about present tax system and capital gains of that?
I mean, you are saying about the approval.
No, he has a present taxation system as of now.
Mhm.
At the same time, he has received a long-term capital,
Okay.
not through 112. So in that scenario, which form has to be?
You have to buy ITR 3 in that case.
But present will not come into picture.
No, ITR 3 will have everything. ITR 3 will have normal business also, it will have representative also.
Present.
ITR 3 is like a bigger circle. Individual having anything can file ITR 3. So 1, 2, 3 is an exception to have limited disclosures only if you have certain types of income. So ITR 3 is an exhaustive return that can be filed by any individual. Yes, yes. This is the bank account schedule, wherein on the right hand corner select account for refund credit. So now we can select which account in which we want refund, and also we can select more than one account as well. You can see over there all bank accounts at any time. Minimum one account should be selected for refund. In case multiple accounts are selected, refund will be credited to one of the validated accounts decided by CPC after processing of the return. So this is the new change that has come up in the bank account schedule. Then coming to disclosure of assets and liabilities, like how we mentioned in the earlier slides, it is applicable only in cases where total income exceeds 1 crore rupees instead of 50 lakhs. This is a new amendment that has come up. Of course, we will discuss this buyback in a very detailed manner after this particular point. So any buyback of shares, the consideration received on account of buyback of shares, now the taxation has moved out from companies to shareholders. So now the shareholders will have to declare that as a part of dividend income under 222F. Now till date we had only 222A to E. Now a new clause F is inserted to handle dividends as a part of consideration on account of buyback of shares. So we'll discuss how it impacts and all that later, but this is what is the amendment that has brought up in the ITR form. So there's a new row over there to disclose dividend income under 222F. This is the detailed disclosure for opting in and opting out. Of course, this is slightly confusing, but the crux of the matter is, if you have opted out of new regime in the past year, you need to give reference to Form 10 IER you have filed. And if you are opting in back this year, again you have to give one more reference to 10 IER filed in the current assessment. So that is the summary of this particular table. 144 BBC. Yes.
Sir, it is for lifetime how many times you can for business?
Okay, so for assessees having business income, you can opt out of new regime once, and then again, last year you had opted out of new regime, and again you can come back to new regime again, but you can't go back to old regime once more. So opting out and opting in can happen only once, not once.
They are telling that new regime for
So AY 24-25 is the first year where new regime is made default. So in the first year itself, we have opted out of new regime and opted new old tax regime. So you have option once to come back to new tax regime, and once you come back to new tax regime, you can't go back to old tax regime. So shifting once and once back. So you can't do shifting again. So basically, one option under 115 BAC 6 cannot be opted once. That is only lifetime once, which is why there is a separate form. For ITR 1 and 2, if you observe, there is no separate form. It can be opted in the return itself, because you can keep shifting in and out how many times ever you want. But to keep a track of how many times you have opted out of 115 BAC 6, there is a specific form for business assessors.
Suppose I opted out of the new regime and I want to continue in the old regime.
Yes, you can do that.
Then in that case, I have to give the reference of the form.
Yes, you have to give just give reference to the Form 10 IEA filed last year. So that will become like a permanent disclosure for you. It will ask whether opted out in the previous years. If yes, give reference to 10 IEA filed in that year. If you have to keep giving reference to that form subsequently also.
dividend approval, can we depend on TAS and AS, or the first person filing, he may not be knowing whether it is approved or not.
Correct. So dividend is a very technical difficulty which everybody faces, because in a lot of places we face discrepancy with what is there in the TIS, what is there in the report and all that. So we'll come to all this discussion later, the importance of AIS and TIS. But to answer your question, AIS and TIS is not the source of information. It is only there to assist you with filing the return. The information that you load in the ITR is the responsibility of the assessee. So assessee will have to collect information from the companies that are invested, and they have to collect information with respect to the dividends that have been declared in those companies. So it can be assisted by AIS to cross-verify whether my calculation is right or not. But AIS or TIS cannot be the source for filing the income tax return.
Approved and received, or only approved?
It is accrued, not received, as far as I know.
Not paid to the bank account.
Yes, it may not be credited, it may be paid in the next year as well, April first week or maybe in April. But as far as what I know, it should be accrued. So long as it is declared before the 31st March, it should be declared.
TDS is made, then TDS certificate will be there.
Yes. Of course, if TDS is made, it will be reflected in both 26AS as well as AIS. So the problem comes when TDS is not made. So when TDS is not made, we won't have information in 26AS for sure. Few companies, they are mandatorily required to report dividends, so we get all the information in SFT. Suppose if the company has made a default of filing SFT, we will not get to know whether the dividend is accrued, and we will not get to know what date is accrued. We may have to look into the emails of the company secretaries of those companies where they have issued these notices, they have filed all these declarations to the email. So that may be a good source for direct information.
That means declaration of dividend is important.
Yes,
If it
yes.
is in the current year.
But if it goes past 31st March, we may not. Of course, there can also be an argument to say that IFOS also has a reference to 145. The SSE still has an option to pay tax on cash basis. So the SSE also can opt to pay tax on cash basis and pay tax on dividend only when it is received. That option is also there. Both PGBP as well as IFOS, we have the option to choose whether I need accrual basis accounting or cash basis accounting.
Because there the problem will come, TDS is not dependent. We can claim it only the
Next year, correct. So if it is made in the next year, preferably it should be disclosed in the next year only, so that one-to-one mapping will be there. So we come to specific disclosures, or rather detailed disclosures that have come up in the existing schedules. So whatever we discussed till now are more or less structural changes, but now inside whatever was there already, there have been few changes with respect to detailed disclosures. So we'll go through them one by one. Firstly, to avail HRA exemption under 1013A, all these years the schedule only had amount of exemption under section 1013A. The responsibility of calculating the exemption was on either the assessee or on the CS, and we were entering the amount manually on the portal or in any of the software. Of course, if we are using softwares, we have the option to enter the rental amounts and all that, so that the utility automatically calculates the exemption and that gets loaded into the portal. But if you are filing it online or using the utility, we had the option only to enter the amount of exemption directly under section 1013A. Now the schedule is expanded to show detailed disclosure. We need to choose whether the assessee is working in a metro city or a non-metro city. Firstly, because metro or non-metro is essential to calculate 40 or 50%. Next, we need to enter what is the actual HRA received. This actual HRA received should match with the gross salary which we have reported. So the gross salary will have basic salary, DEA, HRA, etc. So whatever actual HRA received we enter here should ideally match with the breakup of gross salary which we have disclosed in the earlier schedule. Actual rent paid is something that gets introduced for the first time here. We need to enter how much is the annual rent paid by the assessee in order to claim the exemption. So other things get calculated automatically, and this basic DA also, I checked on the portal, for a few cases it is getting loaded automatically once you enter the gross salary details, and after that if you open 1013A schedule, the numbers are automatically pre-filled from the earlier schedules. But as of now, it is for a few cases it happened, but for a few cases it did not happen. If it is not happening, it's our duty to enter what is the basic salary and dearness allowance, because that is essential for calculating 10% or 40-50% of salary. So once you enter all this, the HRA exemption will get calculated automatically and the exemption will be loaded to the exemption schedule. So that exemption schedule exemption is there under salary itself. So that particular column gets pre-filled with the amount that will be reported in this particular row. So this is a yes, sir.
If the HRA is received for the 12 months, rent is paid only for 10 months, then he has moved to own house and he is claiming section 24 deduction. How will this has to be updated?
As per law, you have to take salary only for those 10 months.
So that is the reason they have.
Maybe that is the reason why they have left it to edit basic salary also. That could be a very good point. But as per law, again, it is only for 10 months. So HRA technically should be calculated every month. So month on month basis, how much ever you receive salary on that particular month, you have to calculate the HRA exemption. So that could be the reason why they have left it as an editable cell. Yes, sir.
Is a tool, HRA whatever is there, multiple HRAs can be claimed just for multiple periods. We have raised the question for 10 months. So whether the form is enabled for multiple HRA claims.
It's not
So if there are two employments with two salaries and one in metro and one in non-metro, still what is
As of now, the portal is not enabled for that. Maybe they will come up with this in the future, but as of now, the schedule is enabled only for entering one detail. So you can either enter metro or either enter non-metro. You can't enter half metro or half non-metro. Maybe they'll come up with that in the future. As of now, it's not there. Go to the next slide. 24B. What is 24B? It is interest on borrowed capital. If the assessee is paying any interest on borrowed capital for purchase or construction or renovation of residential house property or any house property for that matter, the assessee is eligible for 24 Class B exemption if it is a self-occupied property up to 2 lakh rupees for purchase or construction, 30,000 for otherwise, which is renovation or something like that. And if it is a let out property, there is no ceiling limit for claiming 24B deduction. So this 24B disclosure is enhanced now. Earlier, same like HRA, we had just one amount to be entered over there. What is the interest paid to particular bank or financial institution? This interest under section 24B was the same that was there all these years. Now we have a detailed disclosure. We need to choose whether the loan is taken from bank, financial institution or others, and we have to enter the name of the bank or the financial institution or the person from whom you have availed the loan. You also have to mention what is the loan number, what is the loan account number, sorry. If it is a HDFC bank or SBI, you will enter HDFC in column 2, and in column 3 you mention the total amount of loan that you have taken, sanction of loan. You have to enter what is the amount of loan that is taken, how much is the loan outstanding as of 31st of March this year, and what is the interest that you have paid for assessment year 25, which is during the financial year 24-25. This is a very detailed disclosure because this could potentially avoid people claiming fake deduction under 24B. Just because nothing was asked all these years, there was a chance to just enter any amount because all that was asked was just interest under 24B. But now that we have to give detailed disclosures, this will filter out those people who have been taking fake deductions under section 24B. Few changes.
So this one multiple entries you can take.
Yes, I think here it is enabled. I have to confirm that, but here I think they have multiple entries.
And if it's a loan from a person, then what loan number we have to mention?
Loan number we can maybe put not applicable if it is a hand loan or received from friend or something. There I think we can put not applicable. It's not a numerical cell, it's an alphanumeric, so we can put NA or not applicable.
And what about joint loans, sir?
Joint loans you have to put only your share. Yes. Any questions? Yes. Mine says yeah.
Hello, sir.
Yes, sir.
Sir, since he is having I think so, he's constructed 4 buildings and is going for let out of the shop,
Okay.
and we consider it as a rental income and all. And there he has availed the loan from cooperative society, and he has not paid the loan. That is, he's not paid the interest for that year. And we consider it as interest accrued, and then can we go ahead and claim the deduction there?
Yes. 24 rupees on accrual basis.
Correct.
We can avail.
Okay. But at later stage, once because he has not paid there, and at once say after down the line for 5 years or 4 years, at once if he pays there, then he will be in a big task. That will be the thing, right? That will be the question. Because generally what will happen is especially go to banks and all, then if they're not paying, then they will be considered as NPA. But these cooperative societies and all, they don't do NPA and all. So that is where the crux
It's a special case, but as far as law is concerned, interest accrued is what we have to take.
Correct.
Interest paid or payable is what that is the wording.
Correct.
So in the ATC it is actually paid. So once we avail principal deduction under ATC, there the wordings used is actually paid.
Correct.
But under 24B there is no such wording.
Correct.
We can take accrual.
So say after 5 years he paid all at once, then on the 5th year we have to consider only of that particular year. That's it.
Yes.
Thank you.
Any other questions? So under ATC we have a slightly detailed disclosure similar to previous sections. We just had to enter the amount of eligible deduction. If we had maybe PF contribution of 2 lakh rupees, we had to enter 2 lakh rupees under ATC cell, and the amount was taken as 1,50,000 in the amount eligible for deduction. But from now on, we have to enter each of such investments or savings along with its document identification number. Suppose if we have taken a life insurance policy, we have to enter what is the amount of premium that we have paid. Along with the premium, we also have to enter what is the policy number. So we need to enter policy number in case it is a insurance premium. If it is maybe a public provident fund account investment, we can enter what is the account number of that PPF account. So accordingly, whatever the investment or saving is, respective document identification number needs to be entered in the schedule for ATC deduction. And here again, multiple entries are allowed. So if you have maybe 10 insurance policies, you can add all those 10 as a separate document identification numbers, and respective amounts can be added over there. This is one more very interesting change. We have heard about NPS, right? It's a national pension scheme, and it is becoming quite popular in the recent times, only because of that additional 50,000 deduction. So now in order to avail this particular deduction, ATCCD 1B, we should not just enter the amount of contribution, we should also enter the PRAN number. So all these things are just to tackle the bogus deductions that were being claimed all these years. So PRAN number is nothing but permanent retirement account number. In the utility, it is not being made mandatory. There is no ASCII code, the red mark is not there. But when I went through the ITR validation rules, it said that PRAN should be entered mandatorily in order to get the return uploaded on the portal. So ideally, PRAN is mandatory if you are claiming NPS under ATCCD. This is one more change in ATD, again similar to ATC. In ATD, if you are claiming insurance as a part of ATD deduction, you need to enter a separate schedule, and here again we can add multiple rows. And here you need to mention what is the name of the insurer, what is the name of the insurance company. This is the name of the insurance company. Most of the times what happens is, when the assessee is being employed somewhere and the assessee is being a part of a group insurance policy, and the option is given to the assessee to enhance the premium amount and get an additional claim. So what happens there is the contact will always be with the TPA. There won't be any contact with the insurance company. But here they are asking about the insurance company. So here we may have to be extra careful, do not mention the TPA, but to mention the insurance company directly. What is the policy number? Again, we need to mention the policy number and the insurance premium that is being paid in the current year.
That is inclusive of tax.
Inclusive of taxes,
GST
I don't
also
think
is
so. It is excluding GST. Only the premium amount is what it is.
This ATCCD deduction, PRA number, where do we get this?
You will get it in the NPS Trust website. So there is a website which is called npstrust.com. wherein the assessee will log into that portal using the PRAN number and contribute to MPS. So in that you can download.
They will send a card also.
Yes. There will be a card. It will look same like PAN card. Just that instead of PAN, it will be PRAN. Yeah. It's very easily available. For both Atal Pension Yojana and the NPS, there is a common PRAN number which can be used across. 80DD, last year we had a major change in 80DD and 80U disclosure, wherein we had to give reference to Form 10IA, which was made online for the first time mandatory. And inside that form, we had the option to disclose what is the type of disability, who is the doctor who is referred, or what is the certificate that the doctor is issued. So all those disclosures were there as a part of form. Now those disclosures slightly have been brought up in the ITR form itself. We need to now, these are drop down boxes. We have to choose what is the nature of disability, what is the type of disability. Nature of disability is not severe and severe. If it is a severe disability, the reduction will be 1.25 lakhs. If it is a not severe disability, the reduction will be 75,000. So we need to select whether it is a severe disability or a not severe disability. Type of disability, there are 4 or 5 disabilities which are mentioned in the rules. We need to choose one of those. And we need to choose who is the dependent. So 80U is for self. If the assessee themselves are disabled, 80U is where they have to claim the reduction. 80DD is where they are taking care of a disabled dependent. So type of dependent, we need to enter what is the relationship between the assessee and the dependent. PAN of the dependent we have to enter. UDID is something very unique. UDID is called Unique Disability Identification Number. So every disability that is recognized as per science, they have made a database which has all the UDIDs against which the disability is being described in detail. So we need to find out what is the UDID of that disability. I made a small research and it's very easily available on Google. You just type the disability, you get the UDID number. So you need to enter the UDID number along with the acknowledgement of 10IA, which was already there last year also. So this is the detailed disclosure as far as 80DD is concerned. 80E, which is again deduction that is availed for payment of interest towards education loan. Here again, in line with 24B, there is a detailed disclosure as to from where the loan is being taken. Of course, in 80E, we don't have option of a third party. It should either be a bank or a financial institution. We need to choose whether it is a bank or a financial institution, name of the bank, loan account number, date of sanction. Same like 24B, they have made up a detailed disclosure for 80E deduction as well. 80G, there is a small summary table. So although the detailed disclosures have been brought up last year only, now there is a summary table called the eligible donations that we are reporting, with ceiling limit, without ceiling limit, 100%, 50%, there is a detailed disclosure required. The amounts from those detailed disclosures will be summarized in a tabular format, which will somewhat look like this. This table is new, but the detailed disclosure is already there from 2 years ago. 80U, it is similar to 80DD, just that 80DD you claim deduction when you are taking care of somebody else who is dependent on you. 80U is being claimed when you yourself are suffering from that particular disability, and similar disclosures have been brought up in 80U schedule as well. So this is just a summary table which can be used as a reference. So this summarizes whatever we have discussed in the tables earlier. So we'll quickly move on to the changes that have come up. This is one of the most important topics for discussion for today, primarily with respect to capital gains, because capital gains went through a lot of changes in the last year's budget, and a few points where I felt we need some sort of detailed deliberation. I have noted down those few points and we'll be discussing those in detail, which is very, very important for current year income tax filings. So till now, whatever we discussed, if anybody wants to discuss on a particular point, or if there are any questions, we can discuss over here. Yes, we can move forward.
Any cross-reference is possible because policy number, everything details you have to.
Cross-reference, as of now, it may not be possible, but it is very relevant because tomorrow if there is a 143.2 notice and if you are submitting a particular document against, as a proof of this particular deduction, the document number that you are given in the ITR form should ideally match with the document that you are submitting. So it could be a basis for that. And of course, if there is a detailed disclosure at the entry level itself, those who are trying to take bogus deduction, they'll step back.
For example, 24 cases, lot of people, 24-1, lot of people collide with bogus returns. In that scenario, they claim some bank name, they will write account number, it is already closed account number, they will put it.
That's why there's no validation process for that. So they're not looking to. They can do it because there is an information utility available now. So in the information utility, all the banks will upload all the loans, the account number, the outstanding balance. It is being done very diligently by all the banks. So if the department wants, there can be a cross-checking, but I don't think it is there as of now. It is just a basis.
CPC is taking care of it.
Maybe yes. CPC, rather I would say there is a separate wing called RMS, the Income Tax Department. So they will be looking into all these things because this is not a part of 143(1)A. If it is a 143(1)A issue, CPC has all the rights. If it is beyond that, CPC will not have the rights.
No, CPC will identify and transfer the case to housing officer.
That is possible, but under the law there is no provision for that.
No, because they have 100% information.
Yeah. Department in fact knows more than the assessing themselves. So there is no chance of escaping anywhere these days.
So they'll push it to department.
Which is why they are getting so many notices now. Every office has 1 or 2 clients who have received this particular notice, and this will go on till next year March. We have to see how it goes. Given the effectiveness of NFAC, we have to see how these assessments go.
Because they are asking for a VIN number. Previously there is a VIN number is not mandated. So VIN number they can immediately cross-check. What is the document identification?
That's what as of now, we are not in a position to say whether it is there or not, because there could be legitimate errors also. From the assessee side, maybe 10 they would have put less. 10 they would have
Notice
put
comes
more.
then they will have
Yes.
to reply. But in this case, for fake cases, it will be difficult.
Correct.
Immediately we will write. It is you are not availed any loan from the so-and-so bank, so, but you have mentioned that long account number, please verify. Are you confirming this thing is correct?
There could be. Department has been doing some sort of small verifications of these kind using e-verification under 133(6). The scheme, there is a scheme under 135A. So using that scheme, e-verification has been, department is using that as an effective source for collecting information. So through that, maybe yes, they can do it.
Because it's a risky one. Previously we have done it out. Then we cannot suggest.
Yes, sir.
Hello, sir.
Yes.
Sir, can you briefly highlight regarding the employees who has gone from say MNC clients and all goes to US and all, and they get some ESPP options and all, and they shift the company from one organization to another, and then they come back after 2 years or something like that. And that paper, that option paper is there, which we have to file and all, and I think so. There's one particular table in the income tax form which we have to file, and then separate another form is there which I have to attach it.
Correct.
So it gets a lot of work to be done for us from our end. So can you briefly highlight on that? And generally the thing is that to collect the document also is a big task for us. So yeah, so how to deal with that, because we cannot foolproof, we cannot do that unless until the client gives all the details. And generally these clients come at last minute and they will be quite busy because these are big employees, they will be quite busy and all. Getting data also is a big task there. So can you briefly tell how to do this?
Schedule FA is a complete separate session altogether, and like you mentioned, there's been a lot of allotments happening with respect to RSUs, ESPPs and all that. So there are good forms that we can pull out from e-trade portal, fidelity portal. There are a list of documents that we can pull out, and using very minimal documents we can fill out schedule FA. Of course, we need to be mindful of a lot of things with respect to cut-off dates and forex transactions, forex rates that we have to use, exchange rates we have to use, in order to arrive at income in INR. So those things we have to be very mindful of. But as far as difficulty is concerned, I don't think it's very difficult to get documents because it's all standardized over there. So here we have many brokers, but especially in the US, I'm speaking about US, wherein we have good reports that are coming up. E-Trade portal is very good, wherein you can pull out documents very easily. So that is of course a separate session altogether. What needs to be disclosed in which column of the Schedule FA, what are the taxable incomes, if the assessee is over there, and what part of salary is taxable here, what part of salary is taxed there. It's a separate discussion altogether and very fact specific.
Yeah, thank you, sir.
So we'll move to major changes that are applicable for AY 25 and 26. Primarily, these changes are coming out of Finance Number 2 Act of 2024, and very few of them have come from 25 Act as well, which are applicable for AY 25-26. And I have also highlighted few changes that were there last year also, but it is very important for discussion and to be mindful about. So those are the things that I have kept in the slides. Firstly, very simple. This has become a mandate now. Every year you get up for the budget, there will be some change in the new tax regime slabs. So as a ritual, this year also there is a change in the slabs. So this is the slab. Now it has become something like the client comes and asks how much tax I have to pay if I have so and so income. 3-4 years back maybe we were able to calculate it in our mind and tell the clients this much could be the potential tax outgo. But now it has become such that we have to open the tax book, we have to see for which AY what is the slab rate, we have to maybe also use calculator in order to guide the clients how much is the tax payment. So that is how it has become. Nevertheless, this is the slab rate that is applicable for AY 25-26. This is the default tax regime under 115 BAC. So under heads of income we have few changes. Of course, standard deduction if you are opting for new tax regime has been increased from 50,000 to 75,000. So from AY 25-26, if the assessee is opting for old tax regime, standard deduction against salary is 50,000. Standard deduction against salary if the assessee opting new tax regime will be 75,000. Primary change. There is one more interesting change that has come up in section 28. Income from letting out of residential properties should always be considered as income from house property and not income from business. Even if the assessee is into the business of constructing and letting out of properties, income that is earned from letting out of residential units of such properties will always be treated as income from house property and not income from business or profession. Although since they use the term residential, we would still say that if it is a commercial property, they can still go ahead and opt for PGBP and accordingly offer the tax under the head PGBP and not income from house properties. Standard deduction is there under family pension as well. So against family pension, if the assessee is opting for new tax regime, the standard deduction will be 1/3 of the family pension or 25,000, whichever is lower. However, if the assessee is sticking to old tax regime, the standard deduction will be 15,000 instead of 25,000. Angel tax is discontinued. It's a very major amendment that came up last year. 5627B had made a lot of noise in the last 10 years, but there has been a sunset clause that is put up for 5627B from AY 25-26 with effect from AY 25-26. 5627B is not applicable and there is no longer angel tax. And there are, however, some intricacies with respect to valuation. Now that angel tax is no longer applicable, whether merchant banker valuation is really required as per 11UA is still a question mark. But in my view, it is not applicable because 11UA valuation kicks in when there is 5627B. When there is no 5627B, there is no requirement of a separate valuation from a merchant banker. So for issue of shares, whatever registered value or valuation is done as per Companies Act, that should be sufficient going forward. Deduction towards contribution to NPS by employer. This is again a major change only if you opt for new tax regime. So there is a provision to contribute towards the employee's NPS account by the employer. So if the employer is a central government, by default the maximum contribution that can be made is 14%. But now it has been increased to 14% for other employers as well. provided the assessee is opting for new tax regime. Of course, there is no limit for contribution. The employer can still contribute 14% of salary, but if the assessee end of the day is opting for old tax regime, the deduction will be restricted to 10% instead of 14%. So if the assessee is opting for new tax regime instead, then the deduction can be availed completely. 14% of salary can be completely availed as deduction. Again, here PRAN is mandatory for disclosure under ATCCD schedule. This is again a major change, remuneration to partners. So if the partners of a partnership firm are drawing remuneration, the limits of allowable remuneration is prescribed in section 40 clause B. With effect from AY 25-26, this limit has been enhanced. For the first 6 lakh of book profit, the allowable remuneration is capped at 90% of book profit or 3 lakh, whichever is higher. For the balance book profit above 6 lakhs, 60% of the balance book profit should be taken for allowable remuneration. So there are few things which I wanted to discuss over here. Of course, the ceiling limits have been enhanced. There has been a discussion around the CA community as well as to whether we need to amend the partnership deeds which are already there in existence. So the partnership deeds will usually have reference to the ceiling limits which were there earlier. Earlier we had up to 3 lakhs and beyond 3 lakhs. Now the limits are up to 6 lakhs and beyond 6 lakhs. So there is a question as to whether we need to amend the partnership deed itself to incorporate the changes that have come up in the Income Tax Act. To discuss on that, we need to note whether there can be a reference to the provision of the Income Tax Act for the amount of remuneration payable to the partners in the partnership deed itself. So what I mean to say is, while drafting the partnership deed, what if there is a wording that says remuneration allowable to partners shall be as per the provisions of Income Tax Act 1961. Is that a valid clause for allowability of remuneration is a very big discussion that has happened. So in order to answer the question, we need to refer to circular number 739 of 1996. So this 40B ceiling limit was introduced for the first time in 1993 and this circular came in 1996 which gave some sort of an explanation. We'll just go through the circular. The circular has two things. They have given two examples. The first clause says partners have agreed that the remuneration to a working partner will be the amount of remuneration allowable under the provisions of the Income Tax Act. Here if we can observe, there is no quantification of how much is the exact remuneration that each of the partners can draw. The reference is just made to the provision of the Income Tax Act. We need to refer to the Income Tax Act to see how much is the remuneration that can be paid to the partners. In the second clause, however, it says the amount of remuneration to working partner will be as may be mutually agreed upon between the partners at the end of the year. So these two different types of wordings have been given as an example in this particular circular. And they go on to describe it as board have considered representation since the amended provisions of 40B have been introduced only with effect from assessment in 2024. These may not have been understood correctly. Now the board is of the view that liberal approach may be taken for the initial years. So the first 3 years they are given liberty to allow remuneration to partners even if the wordings are of the examples that are stated above. In cases where neither the amount has been quantified nor even the limit of total remuneration has been specified, but the same has been left to be determined by the partners at the end of the accounting period. In such cases, payment of remuneration cannot be allowed as deduction in the computation of firm's income. So the only shortcoming that the CBDT has mentioned here is that you cannot leave the remuneration open. You cannot say remuneration payable will be as agreed by the partners or as by the provisions of the Income Tax Act. As long as it is quantified. Quantification can also happen in the form of this table. In the remuneration to partners clause in the partnership deed, you can say every year up to 6 lakh rupees of the profit earned by the partnership firm, the partners can draw up to 90% of book profit. Beyond 6 lakh rupees, the partners can draw 60% of the balance book profit. So if such quantification is there in the partnership deed, then we can avail the deduction of remuneration paid to partners. Only in cases where it is left blank, or it is just to say that the the partners may decide mutually at the end of the accounting year. Only in such cases the remuneration will not be allowed. So therefore, to come back to the question, if the partnership deeds have quantified with the amount of remuneration that can be paid to partners, or at least specified a formula using which the partner's remuneration can be decided, then you need not amend the partnership deed. You can continue using the same partnership deed and avail the enhanced remuneration to partners. If such quantification does not exist, then we may have to amend the partnership deed and get the new remuneration clause added in that particular deed. So this is something which I wanted to discuss.
So is it better to draft amendment deed or reconstitution deed or addendum is enough?
Addendum is fine. Only a change in particular clause of the partnership deed. There is no partner coming in or going out or change in the profit sharing ratio. So reconstitution is not required. Amendment should be fine, or you can maybe take a fresh partnership deed. Yes.
We have quantified the remuneration 1 lakh per month, but it is restricted to the amount allowed under Income Tax Act. Whether it is valid?
Yes, it is valid. As long as a specific formula is given, it should be valid. That is what the board is trying to say. You can't just leave it open. You can't just say as decided by the partners or something like that. It should be quantified. As long as it is quantified, it should be.
We are only quantifying the remuneration, and this allow is left to the provisions of Income Tax
Yes,
Act.
that can be. Coming to another important change that has come up in the budget 24, which is the change with respect to taxability of buyback of shares. So I have just pointed out what was the position before the change and what is the position after the budget. So what was the position before? So the cutoff date is 1st October 2024. So the taxability of buyback will be different prior to 1/10/24 and will be different post 1/10/24. What is the position before 1/10/24? There are 3 sections that are involved. Primarily it is a capital gain because your shares are being bought back and the consideration is being received by the shareholder. This is basically a transfer. So therefore we need to see section 46A. What does the section say? It says capital gain on buyback of shares or securities shall be the difference between the cost of acquisition and the consideration received. So to give an example, suppose I have purchased shares of Infosys 10 years back for 1 lakh rupees, and today the company is buying back shares in a tender offer, and I am getting around 3 lakh rupees as consideration against the shares that I hold in the company. So the consideration received will be 3 lakh rupees and the cost of acquisition will be 2 lakh rupees, and the difference between the two, which is 2 lakh rupees, will be deemed to be the capital gains in the hands of the shareholder. However, there is a exemption available under section 10. Under 10 clause 34A, proceeds of buyback of shares shall be exempt in the hands of shareholders. So the taxability of buyback of shares got shifted from shareholders to company. So company doing buyback of shares will be subject to a payment of 20% plus surcharge and cess under section 115 QA. So what is the position before 1/10/24? The company declares buyback, it buys back the shares and transfers the consideration to the shareholder. Such consideration is exempt in the hands of shareholder because of 1034A, and the company paying the consideration will have to pay an additional 23.296 because it's a mandatory 12% surcharge and the 4% cess. It comes to 23.296%. The company will have to pay this as an additional tax liability over and above the consideration that is paid to the shareholders. Similar to the DDT which we had a few years back. So the company used to pay dividend. Along with that, the company was also supposed to pay dividend distribution tax. Similarly, we had this buyback tax, wherein the company was having the tax liability on buyback of shares. Now, what is the change? The position is completely changed now. The taxability of buyback of shares has now been shifted to the hands of shareholders. 1034A is scrapped now, it's no longer applicable. A new clause in 222 is being inserted as a part of dividend. So what does it say? Proceeds from buyback of shares I am stressing on the word shares because buyback can be done for any other security other than shares as well. Only for shares the taxability was shifted to the company, now it is being shifted back to the shareholders. So proceeds from buyback of shares shall be deemed to be the dividend in the hands of shareholders. So now that it is put back to the hands of shareholders, 1034A is no longer applicable, 115 QA is also no longer applicable for the company. However, Section 46A is still applicable. For what? Section 46A is still applicable for buyback of such securities which are not equity shares. Not shares rather. They have not mentioned equity, they have just put as shares. So any security other than shares are bought back by the company, the original position is still applicable, 46A is still applicable. Only buyback of shares, the taxability is shifted to the hands of the shareholders and it will be deemed to be a dividend. It is termed as dividend. And under 46A they have also made a small change to say that value of consideration shall be nil and cost of acquisition of such shares shall be deemed to be capital loss in the hands of the shareholders. So now the dilemma is that the consideration that I have received as a part of buyback will have to be offered under income from other sources as a part of dividend income. But the investment that I have made in the company, for that the consideration will be nil under capital gains head and the cost of acquisition will be deemed to be the capital loss. So whatever I have paid to acquire those shares, 1 lakh rupees, will be deemed to be a capital loss in my hand and I can adjust it against any other capital gains, and the respective consideration will be treated as dividend income and it will be taxed at a higher rate if the assessee is at 30% slab. That is the amended position as on date.
That means two parts are there.
Yes,
In
it's two
case of
parts.
buyback, one you show it as a capital loss
Correct.
and one you show it, the full consideration is shown as.
Correct. Correct. So in our example, 3 lakh will be the dividend income and 1 lakh will be capital loss.
Okay. And in the same return, we do this, both the exercises.
Yes, in the same return because the event is on a single date.
Yes.
Suppose the buyback happens in November 24. In the same year, you have incurred a loss also, you have received consideration.
Correct. But this loss can be set off only against capital gains
Yes, correct.
and can be carried forward for a subsequent years. Yeah.
Sir, but if the capital gain is not there, then you can set off this with the income from other sources.
No, that option is not there. So I get your point because ideally, suppose if I don't have any other income for that year, the only income is this 3 lakh IFOS and 1 lakh loss in capital gains because of this. There is no option to offset it.
With the income from other sources.
We need to wait till we get some capital gain and adjust it against that particular capital gain.
And if it is short-term capital loss?
If it is a short-term loss, then you can adjust against both short-term gain and long-term gain.
With the dividend income?
No, not the dividend income. So dividend is separate. So irrespective of whether it is a short-term or long-term, entire consideration will be treated as dividend under income from other sources. But if it is a short-term capital loss on the other hand, you have to wait till you earn short-term capital gain or long-term capital gain and offset it. If it is a long-term capital loss, you have to incur long-term capital gain to offset the losses. It cannot, in either case, it cannot be adjusted against any other heads of income.
And if your total income is below the exemption limit, maximum amount chargeable to tax,
That should be fine.
then you should get this.
No, adjustment is not there irrespective of whether your income is below limit or above limit. So offset of losses is a separate calculation. The gross total income is a separate calculation. So even if in our case, if we say 2 lakh rupees as a consideration, our total income is still less than 2.5 lakhs. Even then I don't have option to offset it. I have to report both 2 lakh consideration and 1 lakh loss and I have to carry it forward to the next year. Next year, if I incur a capital gain, this loss can be offset against that particular capital gain.
Is it aggregated or separate letters? Different section?
No, it is aggregated. It is put into the pool of short-term capital loss or long-term as it is.
What is the reason they get into this? Earlier it was very simple.
This is something which everybody asks to the lawmakers. Unfortunately, we don't have a straight answer. The prima facie reason before that could be that instead of distributing your surplus as dividend, the company is trying to do it the other way around by buying back shares. So technically it's your share of profit. So the company has surplus to distribute to the shareholders because of generation of profits. So instead of distributing it as dividend, the companies are doing buybacks and the taxability is being different. Nothing but you are drawing profits from the company. Under the garb of buyback, you are drawing dividends. So that could be the rationale behind this particular provision. But of course, the admin changes would have been more efficient, like the offset of losses and all that should have been addressed a little more carefully. Maybe we'll get some relief in the near future.
Suppose we are not having any capital profits for all the 8 years, then I don't get any sense.
Maybe if you have any unrealized gain, you can do some harvesting by selling it and purchasing again, so that you can offset it and you get a step-up cost for the subsequent sale. That could be the only option available to us.
So capital loss is the short term.
This TDS will be deducted on the
Just a minute, sir, I'll answer. So short-term or long-term depends on the period of holding. So from the date of acquisition till the date of buyback.
So this buyback, I think to the extent of accumulated profit is there, it is a dividend.
That wording is not there.
That wording is not there. It was there again.
It was not there. So under 222A to D there is a separate wording. 222E there is a separate wording. So 222A to D we see the wordings called accumulated profits, whether capitalized or not. For 222E they use the wording accumulated profits, but for 222F there is no such provision. So irrespective of whether you have accumulated profits or not, this buyback proceeds will be taxed as income from the association.
TDS will be deducted.
TDS is not there for this. There is no TDS section. There is no, unless the consideration is paid to a non-resident. So if it is a non-resident shareholder, any income that is chargeable in India, there is a 195 section. So only in cases of non-resident shareholders, company will have the obligation to deduct under 195. Yes, that is. I don't think it is included in 194. I have to check that. Because 194 is a section for dividend distribution. Whether it includes 222F is something I have to check again.
Is that dividend of the non-TDS should be applicable?
That's what should be applicable, but I am not sure whether they are included in the 194 or not. That is subject to further reading of the law. Yes, ma'am.
In the ITR, where do we disclose this buyback of
I'll show you all that. So this buyback we have seen, I think, under income from other sources, there is a new line item that is added. So you can see this schedule OS. So this will have dividends gross under 1A, under which we have 1, 2, 3. In cell C, we need to disclose this dividend income. So dividend income under section 222F is included in schedule OS itself.
This is clear. But what about the capital loss?
That I'll show you. That's there in the subsequent slides. So I hope it's clear, buyback distribution. It's pretty simple now. Actually all these years the law is a little complicated. Now only that set off of losses is something that needs more deliberation or discussion. Apart from that, the proceeds listing will be deemed dividend. Whatever cost of acquisition is there, that will be treated as capital loss in the hands of the assessor. And period of holding, there has been a major overhaul. Now there is no longer multiple classes of assets and multiple periods of holding for each class of assets. Now we have broadly 3 categories. That too, one of such categories could be because of a mistake or a slight oversight. For listed securities, EOF, which is equity oriented funds and zero coupon bonds, the period of holding remains same. If the asset is held for less than 12 months, it is short term. If the asset is held for more than 12 months, it may be long term. For business undertaking referred to in section 50B. So section 50B refers to provision for tax under slump sale. So if the company or any other assessee is doing a sale of business undertaking by way of a slump sale, the calculation mechanism of capital gain is specifically given in section 50B. and the period of holding to determine whether such transfer is a long term or a short term is also given in section 50B. So under section 50B it says if the undertaking was held by the assessee for more than 36 months, it should be treated as long term, otherwise it should be short term. In my view, they wanted to amend this as well, but they forgot to do it because this is not a part of 242A. Other long-term, short-term bifurcation is there in 242A. However, this is there as a separate provision in 50B itself. So this, by virtue of an amendment subsequently, I think that also should be covered under 24 months category. So for all other assets, it is very simple now. 24 months is the criteria to see whether the particular transfer is a transfer of long-term capital gain or long-term capital asset or short-term capital asset. There are few more amendments in capital gains itself. We'll take a short break in 15 minutes. We'll break for 15 minutes and then we'll continue. We have few changes in capital gains. Come back. I think it's visible. Somebody asked about TDS on dividend. We just confirmed that TDS is applicable under 194 for the buyback of shares. Sorry, 10%. 10%. So
This will get in 26 years.
This is So we'll continue with the other amendments. Main amendments have been either changes in period of holding or change in the rate of tax that is applicable under 111A, 112 as well as 112A. So we'll discuss each of this in detail. Sorry. So what is the change under 111A? 111A is basically applicable for transfer of assets being listed shares and equity-oriented mutual funds which are short-term in nature. If the transfer happens before 23rd of July 2024, the rate of tax was 15% of the capital gains. Now the updated rate of tax will be 20%. So if the transfer happens prior to 23/7/2024, the tax rate is 15%. If it happens post 23 on or after 23/7/2024, the tax rate stands revised at 20%.
What about indexation?
Indexation is not available for short-term gains.
No, for long term.
For long term will come in the next slides. So for short-term gains, anyways, there is no indexation. There is no discussion on that. So for other assets which are short-term in nature, the capital gains on transfer of any other asset, the tax rate is the same. If it is as applicable for that particular assessee. If it is an individual, it will be applicable at slab rates. If it is a company, it's applicable at 25 or 30 or 22 plus surcharge. So whatever is your regular rate of tax, that regular rate of tax will be applicable for short-term capital gain on transfer of any other asset. So this is the revised rates as far as STCG is concerned. So as far as LTCG is concerned, we have a huge discussion to make. So 112A is primarily applicable for assets which are listed shares, equity-oriented mutual funds, and equity-oriented mutual funds. Basically, what the class of assets that are covered under 111A. If it is a short-term asset, it is covered under 111A. If it is a long-term asset, it is covered under 112A. So, what was the rule before? What was the provision before? If the transfer is before 23/7/2024, the tax rate was 10% on gains beyond 1 lakh rupees. So what is the revised position? The revised position is if the date of transfer is on or after 23/7/2024, the capital gains rate will be 12.5% on gains beyond 1,25,000 rupees. So a very important point to make note here is they have inserted a proviso below 112A to say that 1,25,000 should be calculated on a yearly basis, which means from 1st April 2024 till 31st of March 2025 on the total capital gains that is calculated under 112A schedule. On the entire capital gains, the exemption of 1,25,000 will be applicable. So we'll see how it gets reflected in the form and the intricacies as to whether that 1,25,000 can be apportioned to 10% incomes or 12.5% income. So all those things we'll discuss in the coming slide. So as of now, we'll just discuss the amendments. What is the amendment? Transfer prior to 23/7/24, 10%. Transfer on or after 23/7, 12.5% is the revised rate. What is the revised rate under 112? 112 is nothing but long-term capital gain on any other asset other than those covered under 112A. So if the transfer is before 23/7, it is 20%. If the transfer is on or after 23/7, the tax rate will be 12.5% on the capital gains amount. Of course, this 12.5% comes with a condition that there shall not be any indexation benefit. So this 20% which was there prior to 23/7 was along with indexation. Now after 23/7, the date of transfer is post 23/7. The capital gains is calculated excluding indexation. So it is straightforward cost of acquisition and cost of improvement. On the capital gain amount, 12.5% will be calculated straight away. Of course, it came with a lot of backlash, and subsequently indexation was partially restored with some conditions. So what is the general rule? For long-term capital assets, benefit of indexation is not available if the asset is transferred on or after 23/7/2024. Only original cost of acquisition and original cost of improvement is available. However, there is a special rule now in section 112 which says we need to basically comply with these 4 conditions. What are these 4 conditions? 1, transfer should be a capital asset being land or building. Suppose we have a long-term capital asset which is not land, building or both. Suppose if we have jewelry or any other capital asset for that matter, indexation benefit is still not available. Indexation is restored partially only on assets which are land, building or both. And the transfer should be by an individual or HUF being a resident. So what does it mean? Non-residents are completely out of the picture. For residents, it is applicable only for individuals and HUFs. If the partnership firm or a company transfers land or building, indexation is still not available. Asset should be purchased before 23/7. This is the primary condition, because if the asset is purchased after 23/7, anyways the new law is in force, and without indexation we have to calculate 12.5%. Only if the asset is purchased before 23/7/24 and the asset should be transferred on or after 23/7. Why is that condition? Because anyways if it was transferred before 23/7, old provision 20% along with indexation would have been applicable. Now that we are discussing about the new provision, asset should be purchased before the cut-off date and should be transferred after the cut-off date. Asset should be transferred by individual or HF being a resident, and the asset should be land, building or both. If the assessee satisfies all these conditions, and we need to do a small check. If without giving effect to the new provisions, if the tax under old provision was beneficial, then such excess tax under new provision shall be ignored for the purpose of computation of capitals. So what does it mean? If we need to basically create 2 tables. Position prior to 23/7 as if it was prior to 23/7 and as if it is presently available. So suppose in the first part of the calculation, 20% along with indexation, the tax is coming to 3 lakh rupees. 12.5% without indexation, tax is coming to 4 lakh rupees. Such excess means 1 lakh. 1 lakh will be ignored for the purpose of tax calculation, and 3 lakh will be taken ahead for the purpose of tax calculation. Here a small point that needs to be make sure. Of course, this is subject to how the utility is being drafted, or utility under ITR 2 and 3 is rolled out. The provision says only for the purpose of calculation of tax, because this is a special provision under section 112. So this excess shall be ignored is only for the purpose of determining what is the tax that needs to be paid on such income. However, for all other aspects, suppose you need to offset a capital loss, you can't see what is the position before after. You need to stick to the new position. Suppose you have say consideration of 50 lakh and cost of acquisition of 40 lakhs. Index cost would have been 45 lakhs. And such index cost is more beneficial to me, and for the purpose of calculation of tax to be paid, I will still take the 45 lakhs index cost of acquisition. But for the purpose of other calculations or offsetting of losses, my capital gain is still 10 lakhs. So basically there is no amendment being made in other sections like set off of losses or computation of gross total income. The amendment is made directly in section 112. If this amendment was made in section 48 itself, then we would have had the option of having this beneficial provision for other things as well. But since this is directly being made in 112, only for the purpose of calculating how much tax needs to be paid, we can give effect to this special rule. However, for all other purposes, my capital gain is still 10 lakh rupees, which is without giving effect to indexation if the transfer is post 23/7/24. This is again subject to how utility is being drafted, which is primarily the reason why there's been a lot of delay in rolling out the utilities. After we have the utilities in place, I think maybe we'll be able to answer all these questions in a more detailed manner. Here we have just put up a small answer.
So we cannot have a capital loss then?
No, we can't. So in case of negative, it should be zero. Because only excess should be, can't be capital loss. Unless the cost itself is more. The cost itself is more, even without indexation, it exceeds the consideration. Only in such cases, loss can be. Any other questions on that topic? Yes, sir.
How do I need to disclose foreign stocks, sale of foreign stocks? What section?
Sale of foreign stocks again come under the regular calculation because it is not eligible for 112A. So it is as good as you are selling any other asset. So it should be disclosed in the respective schedule.
Period of holding for the
24 months. Any apart from those two, any other asset you have, it is all in 24 months. Yes.
Why non-resident has been excluded here?
Why is something that I cannot answer.
But specifically because they put it word by resident.
No answer for that. Maybe because non-residents, I know there's a separate mechanism for all those calculations and all that. They also have first proviso to 48 where they have currency exchange and all those. So indexation is automatically taken care of. So maybe because of that, but not sure. And that too again, if we go that route, we can ask why only for individuals. So
No full stops.
Some policy making decision.
In case of international stock which he raised, there's both a currency depreciation profit and a stock appreciation profit. The stock appreciation profit is taxable under Schedule 115A. What happens to the currency depreciation? When you purchase the rupees, let's say 70 rupees, and when you sell the current Indian rupees versus the dollar is 86. So what happens to the 16 rupees gain that you're making in the shares, foreign equity shares?
Correct. So this is actually a point which the rule has a very small shortcoming, which says for purpose of computation of capital gain, they have given the exchange rate. So maybe we have to use the same exchange rate, or maybe we can use what was the exchange rate prevailing at the date of acquisition. Maybe we can use that rate as far as the conversion is concerned. But there is no clear-cut answer for that in the rules.
In 115 years, clear that you take both the selling price. Selling price as well as the cost to convert based upon rate of exchange.
No, I don't think there is a specific mention for cost. Under 115A, as far as I remember, there is no specific mention for cost. They have mentioned for the purpose of computing income from transfer of those assets, you can consider this.
Right? So both the gains and the both the selling price and the cost get converted to the same rate. The rate of exchange prevailing on the last day of the previous month.
Correct.
So
there are two interpretations possible.
Thereby it looks like the currency depreciation profit is escaping tax.
Escape is correct. So that could be the case. So there could be two interpretations to this. So first calculate the capital gains in INR or maybe rather in dollars and convert based on the rates prevailing on the date of transfer. One just last month before the date of transfer. That could be one interpretation. Or take that only for conversion for sale consideration and use the same logic for cost of acquisition as well.
Why should anybody do it if there's an ambiguity there?
There is an ambiguity there because there is no specific mention as to for what you have to use this rate. So that is an ambiguity.
Case law in that?
Sorry?
Any case law in that?
No, sir. Not case law anything for that per se, but as a general rule, if there is any ambiguity in the law should refer the SSC. That is what is a settled position. So based on that position, maybe we can take this conservative view optimistic view to say we'll just first calculate capital gains and maybe both we can convert on the date of transfer itself. But there's no clear-cut answer to that.
So set off is always for the new provision capital. And one more thing is it's a NRI. He is having children in India. He has a property in India. So he will give the properties to his child here. And later they sell the property.
Later, if the asset is sold by the children, it will be capital gain in the hands of the children, and the original cost of acquisition will be the cost paid by the original buyer.
So whether indexation will be applicable to the children?
Not. If the children, whoever is received the property, if they transfer it after 23/7, there won't be indexation. It's the same provision.
No, the property was acquired before 23/7.
Okay. Property was acquired by the original buyer before 23/7. Property was transferred after 23/7. Yes, they can still make use of this provision.
No, but indexation is applicable or not for the...
That's what indexation prima facie is not applicable.
Okay.
Suppose if this, as per this special rule, if it is coming to be beneficial to the children, then they can avail it. It's okay. Because as far as cost of acquisition is concerned, there are specific rules in section 49. It says the cost will be the cost of the original buyer. And we have enough case laws, Mandula Desha and all that to say the period of holding should be from the original purchase. So the original purchase is long term, and because of the original purchase being the first buyer, it's a long term asset. It is a transfer post 23/7, purchase before 23/7. The regular rule will be applicable. First calculate without indexation, see with indexation if it is beneficial, take that, otherwise.
Yeah, so the thing is when the child transfers the asset after 23/7, still indexation is applicable.
Yes, that's what. It will be the same rule. It is as good as the child is transferring any other asset. In this case, the asset is inherited. It's as good as
Inherited after 23/7.
inherited after 23/7.
Then it won't be
No, no.
There is a bar on non-residents.
Correct, correct.
So the non-resident will transfer the property to the child.
Okay, so you are saying the asset was acquired much before, but the asset is transferred to the child as part of gift after 23/7.
23/7. So whether no the child can take the benefit of indexation, then the child sells the property.
Yes. I don't think it is possible because specific mention in the law is there only for cost of acquisition, not for determining the period of which under which the assessee who is transferring is holding the asset. So in my conservative view, it should not be possible. It should be treated as it is acquired after 23/7. Because it is acquired by the assessee after 23/7 by way of gift. Just that the cost and indexation was from the earlier period. Mandula Desha also specifically talks only about indexation benefit, not for any other purposes. So the cost we can take from earlier period. Indexation, if it was possible, it would have taken from earlier period. But since the assessee has acquired the asset after 23/7, it should not be available. Not be available. Correct, correct. That is again based on settled case laws, not based on position of law in the Act. So that too only for the benefit of indexation, not for other purposes. So which is why if it was transferred by way of a gift before 23/7, we could have still gone to the earlier provisions. But since it is acquired by the assessee after 23/7, I don't think it is permissible.
Regarding foreign dividends, what is the period you take, either financial year or a calendar year?
So there are two things in this. We'll of course come to Schedule FA briefly a little later. So any income that you have to offer in India should be based on financial year. So income reporting is 1st April to 31st of March. Just that in Schedule FA, when you disclose income arising out of a particular holding, that should be as on December 31st. So disclosure in Schedule FA is as on December 31st, but under computation of income, under income from other sources we are declaring, it should be based on financial year basis.
Claiming of credit then, 104.
Claiming of credit also is based on financial year basis. Yes. There is of course a slight mismatch with respect to 1042S and all that. We will get only for, suppose if you are filing today, we get for 2024 calendar year. So in that part of the form, we have to maybe exclude the first 3 months, in the next include the next 3 months. So all that we have to do. So that reconciliation is possible.
One more. I have a long-term capital gain of, for suppose 85,000 and a normal business loss of 75,000.
Business loss.
Business loss, normal business loss.
Okay.
Now one client is asking me, can I claim the 1.25 lakhs of exemption for capital gains separately and carry forward this business loss?
That is not possible. Because calculation of tax under Schedule SI happens after CYLA. So current year losses should first be adjusted and then the remaining should be brought to tax under Schedule SI.
Can I get any reference of some section or something?
No, this is, see, offset of losses. What happens in 112A is that 1,25,000 is not an exemption available to you. It's not coming under section 10 or it's not coming under any deduction section. Just that the tax will be 12.5% beyond gains of 1,25,000. So 1,25,000 is only a calculation mechanism of computing tax that you have to pay. 1,25,000 is technically not an exemption. So since it's not an exemption, it is still part of your gross total income, still part of your total income. So it should be calculated after setting off a process.
The problem has come with ChatGPT.
ChatGPT is something which we can't discuss as well. ChatGPT is very famous for giving wrong case laws, wrong provisions. Sometime back I was searching ChatGPT for general stuff. And then I came across some section called 69T, which is not there in income tax. I was shocked to see 69T. What is this? ChatGPT should be kept away from income tax returns.
There's recent article saying it reduces your cognitive behavior, cognitive skills.
So there's a small summary. We can have this handy when we have the presentation with us. So these are things which we have discussed. Just that these things are put in a tabular format so that it's easy for us to understand when we are referring. So this is what I was talking about. Tax rate on LTCG under 112A. If the share is transferred before 23/7, the tax rate is 10%. Of course, the law is 10% on gains beyond 1 lakh. I am not considering 1 lakh because on the entire assessment year, now the limit is 1,25,000. So 10% if the transfer happens before 23/7, 12.5% if the transfer happens on or after 23/7. Now the controversy is, what happens if I have capital gains only, suppose to give an example, I have sold my shares only during April and May month and I have not sold any shares thereafter. Can I pay tax at 10%? I have a capital gain of 1,50,000 on transfer of equity shares, which has happened only in the month of April and May, which is of course prior to 23/7. Technically, the tax rate should be 10% on the capital gains. So, can I claim 1,25,000 exemption and pay only 10% on 25,000, or what is the way out? This is something which is left open. We have to see how the utilities will be rolled out. As of now, we don't know the answer for this. We need to see how the utilities will take numbers from different columns and calculates the tax. Accordingly, we'll have to follow this. But as of now, this controversy remains open. Adjustment of exemption of 1.25 lakh against gains before or after is still unknown. It may so happen that prior to 23/7, I have 60,000 profit. After 23/7, I can have 70,000 profit. So both put together, my gains are beyond 1,25,000. But how do I adjust that first 1,25,000? Can I say the entire 1,25,000 I first consume to 70,000 and the balance I will adjust to 60,000? I can pay lower tax. I can pay tax of 10%. But if I adjust 60,000 first and then keep the balance for next 70,000, I may end up paying higher taxes. But how the utility calculates this sort of tax rate is still unknown. Once we get the utilities rolled out, maybe we'll have the answer to this particular question. And as far as law is concerned, even in law also, this question is not answered. This particular point is left unaddressed. Short-term capital gain is pretty simple. 15% has been made, 20%. All other capital assets, the slab rate remains the same. So this is the summary table which is there from one of the journals I have taken. I found it to be very useful. So once you get the presentation, within this, maybe you can paste it in our office and we can refer to this chart whenever we have some doubts. Because I'm pretty sure now going forward, at least for the next 1 or 2 years, when we hear the term capital gains, we may have to invariably go back to the books and see what is the position, what is the nature of asset that is transferred, what is the tax rate, what is the date of transfer. So 1 or 2 years during this transitional period, I think we'll have some sort of confusion. So these kind of ready reckoners will be handy for us in guiding the clients. So we discussed all the changes that have come up in capital gains. Now we'll quickly see how to report these changes, how do we report this in the ITR forms. Few structural changes have been made in the ITR forms in order to incorporate these changes, whatever we discussed right now. So short-term capital gain, we never had this disclosure of date of purchase and date of transfer. So this date of purchase and date of transfer was there only for long-term capital gains. For short-term capital gains, we were reporting a consolidated number. What is the total full value of consideration, what is the total of cost of acquisition, and the total capital gain was directly taken to the respective schedules. But now we need to enter the date of acquisition and date of transfer, primarily because there is a change in the tax rate. If the transfer is after 23/7, tax needs to be paid at 20%. If it is prior to 23/7, tax needs to be paid at 15%. Maybe in order to determine that particular amount, this change is being made in the ITR forms. Now we need to report date of acquisition and date of transfer even for short-term capital gains. In every other schedule of capital gains, there is one column which is being made mandatory, whether the transfer is before 23/7 or whether the transfer is after 23/7. Mainly to determine what is the rate of tax that needs to be applied on that particular capital gain. In the entire CG schedule, under each of the rows, you need to disclose whether this is a transfer prior or a transfer post 23/7/2024. So this is the place where we were speaking about buyback taxes. So we saw that under income from other sources, we are required to report it as a dividend under 222F below other dividends. On the other hand, in CG schedule, we need to disclose the loss. So what is the loss? The actual cost of acquisition will become capital loss, will be deemed to be capital loss. If it is a short-term capital loss, we will report under the short-term capital loss schedule. If it is a long-term capital loss, we will report in the next schedule. So this is the place which is inserted now to incorporate capital loss on buyback of shares on or after 1st October 2024. Deduction under section 48. So this is the amendment which is made for individuals. We need to calculate in a different way. For other than individuals, we need to calculate in a different way. Of course, this is taken out from ITR 2, so this primarily pertains to individuals. Therefore, I have put up the screenshot. Everywhere, wherever we need to report a particular transfer or a particular sale of something, we need to report whether the sale is before 23/7 or whether it is after 23/7. So this is the place where that 112 effect is given. Total long-term capital gain on immovable property, because it is applicable only for land, building or both. Before 23rd July, after 23rd July, total excess to be ignored is also need to be disclosed separately. So because the total of the capital gains for other purposes is still without indexation 12.5%. This total excess to be ignored will be disclosed as a separate part. I think this will be an automatic calculation in the utility, just that it comes as a separate row in the schedule. So again in the LTCG and 112A also, directly from schedule 112A in the summary table, it will have 2 rows separately, one for before, one for after. Yes, this is something which I wanted to discuss specifically. There are few intricacies which we need to discuss in capital gain, primarily arising out of these amendments that have come up with respect to the change in rates. This is a schedule in ITR 2 which is for disclosure of capital gain account scheme. So last year we saw that we need to report the account number, the IFSC code, the bank where you have opened the capital gain account scheme. So those were the amendments that were brought in the last year's form. So this year, of course, we need to add an additional disclosure to say whether the violation has happened before 23rd July or after 23rd July. Because we all know, suppose we are taking an exemption under 54, in case the assessee fails to purchase or construct within the stipulated period of time, the violation, in the year of violation, the capital gain which was taken as an exemption earlier will be deemed to be the capital gain in the year of violation. So, in current year's form, they have added a new column in CGA's disclosure to say whether the date of limitation or withdrawal was before 23rd July or not. Suppose I have a capital gain account scheme and the period of 3 years get lapsed before 23rd July, the law is different. And the period gets lapsed after the cutoff date, which is 23rd July, the law is different. Which is why they have brought in a new column to disclose whether the period of limitation is before or after. So there is a slight confusion here. I would like to discuss this with, in a form of an example. So let's see this small example. Residential building was sold on 10th April 2021. Dates are very important in this, so I want everybody to pay attention. So to 10/4/21 is the original date of transfer. What is transferred? A residential building is being transferred. Sale consideration is 1 crore rupees. Cost of acquisition is 80 lakh. Of course, 2021, so we would have taken along with indexation or without indexation, we are not bothered about that. The cost of acquisition which was allowed under section 48 was 80 lakh rupees. Capital gains naturally is 1 lakh minus 80 lakh, 1 crore minus 80 lakh, which is 20 lakh rupees, which is claimed as an exemption under section 54. The assessee has agreed to purchase or construct a property within 2 or 3 years respectively and has opened a CGAS the very next day. 11/4, of course, the assessee has time till the date of filing the return. In this case, let us assume that the assessee has immediately opened the capital gain account scheme and has deposited the entire 20 lakhs in the CGAS account. So the date of transfer is 10/4/2021. What is the time period allowed to the assessee to construct or to purchase? The higher limit is 3 years. Because the assessee can purchase within 2 years, or the assessee also has an additional 1 year to construct the property. And at the time of opening of CGAS, it's not a mandate to choose whether you are purchasing or constructing, just that you need to have the intent of either purchasing or constructing a residential house property. So 3 years period gets lapsed on 9th of April 2024. From 10/4/21 to 9/4/24 is the 3-year period which got lapsed. So naturally this 9/4/24 falls before 23rd July 2024, which is the cutoff date. So as per law, what is the position? What is the implication of non-compliance? 20 lakh exemption claimed earlier shall be deemed to be capital gains for assessment date 25/26, which is the year of violation or completion of the limitation period. Under section 112, of course this is before 23/7. So therefore, under 112, 20% on 20 lakh will be the capital gain tax that the assessee needs to pay, which will come to around 4 lakh plus cess, which is 4,16,000 rupees. So this example is pretty much clear to everyone. We'll go to the next example. Here what happens, instead of April, the transfer happens on 10th of August 2021. The same facts remain, but however, the period of limitation gets expired on 9th of August 2024, which is after the insertion of the new provision. This is after 23/7/2024. Now at what rate the assessee is subject to tax? This is the confusion. So 20 lakh is the exemption claimed earlier, which is deemed to be capital gains for assessment year 25/26. But the point is, or rather the question is, the assessee has to pay tax at 20% or 12.5%. The exemption was claimed at 20% when the rate was 20%. Now that the period of limitation is after 23/7, when the tax rate has come down to 12.5%, the assessee has to pay tax at 12.5% or 20%. Because I have taken a very small example where the difference is a mere 1,50,000. There could be a very big case where the difference could be in crores as well. So what should be the ideal interpretation of law in this? There were of course a lot of discussion going on in the community, and there was a lot of advices being given to clients to say you have claimed deduction under 20%, so now the tax rate is changed. So let that violation period get over, we'll pay tax at 12% and we'll save 5.5%. So is that the correct position of law? Absolutely not. Because the intent of law is never to give such absurd reliefs, right? So everybody understood the scenario. The violation is after the rate change, the transfer is before the rate change. So it's not just in CGAs. I just gave one example. There are many such instances in the law. I have listed down a few of them. Section 45(2), conversion of asset into stock in trade. So what happens there? The triggering scenario is conversion. But when do I pay tax? It gets deferred to the year in which the last stock is sold. The stock is subsequently sold. So the transfer has happened at the time of conversion and the asset is transferred. Maybe at that point in time the rate was 20%. Now the stock is being sold, and when the stock is being sold, the new tax rate is into picture, which is 12.5%. Can the assessee pay tax at 12.5%? The answer is no. We have similar scenarios in 45(5)(a), wherein the agreement will be entered in a prior year, and the time of taxation will be deferred to the year in which the assessee gets the possession of the property. So, similar to the first position which we discussed, here the tax rate has happened in between these two events, and the assessee could have claimed a lower rate of tax, but that is not possible. Similar scenarios are there in 47(a), 1, 3, 4, wherein a violation of 47, one of such example is transfer between a holding and a subsidiary company. They have to follow certain conditions for the next 5 years. If the conditions are breached, in the year of breach of those conditions, the exemption claimed earlier will be deemed to be capital gains. So similar scenario we just discussed for 54, 54F and 54EC. So what should be the tax rate in the above scenarios? The answer lies in the wordings of the law. If we carefully observe under 112, it says transfer should be on or after 23/4. In all the above scenarios where we discussed, the transfer date was always the original event date. Just that the time of taxation or the time at which you pay tax was deferred to some other assessment year. But the original transaction happened before 23/7 and the transfer has already happened before 23/7. So since the wording uses transfer of asset after 23/7, the original tax rate of 20% is still applicable if the assessees do not purchase or construct house within 3 years, or in any of those scenarios which we discussed, there is a violation of the provision and because of which there is a deemed capital gain that needs to be paid. It should be paid at the rate which was prevailing on the date of transfer, which is of course prior to
payment, postponement of payment of taxes.
Yes, that's what. This is just
correct. Postponement of payment of taxes.
Correct.
In this scenario, it is cannot applicable the new rate. It is automatically goes to
correct. Old rate. Yes, because the transfer has happened before 23/7, because of which the tax rate also should be the earlier rate, which is 20%. So date of transfer in all the above scenarios are original dates of transfer of the assets. Only the violation is post 23/7. So therefore, it should be deemed to be a transfer before 23/7/2024. Event of transfer is before 23/24, and therefore provisions as it should before 23/7 should be applicable. Other few changes we'll just discuss we discuss only few important ones. 47(3), it is a transfer by way of gift or will. So it was applicable to any assessee. Now the transfer should be by an individual or HF. So only if the transfer is made by an individual or HF, 47(3) is applicable. If the transferor is anybody other than individual or HF, 47(3) will not be applicable. But there is a small discussion over here. There is a dilemma with respect to valuation. Suppose there is a company, there is a private company which is not, of course, which is not a individual or HGF. Therefore, if the company gives, let's take an example of a share of another company. So a private limited company is holding shares of some listed company. It is transferring it to some other third party without any consideration, which means technically it's a gift. Therefore, that transfer was covered under 47(3) all these years because it was gift or will. But now that it is applicable only for individuals and HGFs, companies' transfer is still treated as transfer and capital gains should be paid on the transfer. But what will be the value of consideration? What could be potentially be the value of consideration?
Rate of transaction value.
Transaction value that can be used, but the section 50CA or 50D specifically uses the word where consideration is received. In present scenario, there is no consideration received. So in my view, the law needs to be amended in 50CA and 50D to incorporate such changes where whether consideration is received or the transfer has been effected without any consideration. In such cases, the valuation should be based on these rules. So that amendment is not given effect to in section 50CA and 50D. So therefore, as of now, one can still argue that although this is a transfer, there is no computation mechanism. Because there is no rule or there is no mechanism through which I can calculate value of consideration, and because of that my computation fails, and since my computation fails, charge fails. So therefore one can still argue. Of course the department will take a contrary view in this because the intent of the law is to tackle those transactions. So maybe in a few years we will have an amendment coming in these sections to tackle transfers for without consideration. Section 57, there is a small change. It says no deduction against dividend income declared under 222F. So this is a natural consequential amendment because you cannot claim any expenses or anything against the dividend income you are declaring under 222F. There is another interesting provision which is inserted in the law. 139(9)(a) is being inserted to say provisions of 139 shall be made applicable to returns filed pursuant to an order under 119(2)(b). So we all know 119(2)(b) is a special power given to CBDT. Of course, by way of circulars, few of the powers are delegated to principal commissioners, especially for filing returns. So if I file the return under 119(2)(b), pursuant to an order under 119(2)(b), the provisions of 139 will be made applicable. So we are still yet to figure out what could be the consequences of that. Will this return again go through 143(1)? Will this return have a 143(2), or whether this return will have other implications? So we are yet to figure out the after effects of inserting this particular provision in 139(9)(a). But however, this is a small change that is being made in the enactment. There are few important points which are not brought in the amendments as far as Finance Act 24 is concerned. These are the amendments which are already there, but I thought few points are a little bit important for discussion, so I have noted down these 3 points. Interest paid on borrowed capital can be claimed as cost under section 48 only if the same is not claimed as deduction under 24B. This was a provision which was inserted in the prior year's budget to say that if the interest is claimed under 24B, the assessee has exhausted the option of claiming that as a reduction. So no longer the assessee has the eligibility to claim the same interest as deduction under section 48 of the Act when the asset itself is transferred. To give an example, the assessee is having a self-occupied property which is taken on loan. The assessee has been claiming this as interest under 224B all these years. Subsequently, assessee transfers this asset to somebody. So when the assessee is transferring, the cost of acquisition should be only the cost of acquisition, and it should not include the component of interest, because the interest is already claimed under 24B. In case the assessee has not claimed under 24B, suppose the assessee has been claiming new tax regime, under which for self-occupied property there is no provision to claim interest on borrowed capital. In such cases, the assessee can claim 48, such interest deduction under section 48 as a part of cost of acquisition.
So suppose if interest is paid more than the claim amount, then what will be
differential amount can be claimed.
Differential can be claimed, yes. Differential can be claimed.
This will be claimed as cost of improvement or cost of acquisition.
It can be for both.
No, every year it will be paid interest. So every year if he capitalizes, it is cost of improvement.
Correct. It can be cost improvement. So both are 48, so it should be fine. The terms that we use could be acquisition and improvement, but the treatment is still the same.
So 1 year he is claiming under 24B. Again next year he goes to new tax regime. There is not claiming.
So there, whatever is not claimed can be claimed. Yes. So the law is very clear. What is claimed cannot be claimed. What is not claimed can be claimed, because it's also part of cost for the assessee. If for the business assessee, we have 36(3) where we specifically have interest on borrowed capital. Similar provision is not there in other heads of income. So that's why whatever is not claimed can be claimed as cost. There's a new section 115 BBJ which was made applicable from AY 24-25 for the first time, which addresses income from online games. So the reason why I have put this point is because we have seen a surge in people opting for, or rather people going for online games like Dream 11 or Rummy Circle and all those things, wherein there will be a lot of intricacies involved. There will be a buying deposit, there will be cross winning, and there's a whole lot of discussion around whether this buying deposit can be claimed as deduction under 57 prior to insertion of 115 BBJ. So what happened is, in 2023, the government came up with a clarification to say this online game is not equal to all these lottery winnings and all those things. Therefore, it needs a separate section on its own because of the mechanism with which it operates. It's a different mechanism with which it operates. So therefore, the need for a new section was there, and therefore 115 BBJ was introduced, and corresponding TDS also was introduced. So whenever there is an online game and the taxpayer has won something, against those winnings, the online gaming platform has to deduct tax at 30% and then remit the balance 70% to the account of the assessee. What happens is, under the utility, we have an option to report incomes under 115 BBJ. It is a single schedule which has only two cells, which is income under 115 BBJ and the amount of income that you have earned. What happens if the assessee has made a profit in the first 2 quarters? The TDS happens at a quarterly level. The online gaming platform has made TDS on the profits that are made in the first 2 quarters. Suppose the profits will come up to 40,000 in the first 2 quarters put together. Subsequently, the next quarter 3 and quarter 4, the assessee has in fact incurred a loss of 50,000. In case of a loss, the online platform will not do TDS, and there won't be any subsequent reporting from the online gaming platform. Under Schedule 115 BBJ in the ITR utility, we do not have the option of disclosing line item wise. We can't say on this date we had a profit, next day we had a loss, and then the summation of that will come out as a net loss. As of now, there is no such facility in the income tax utility. Therefore, we need to enter the net profit or loss in the entire year. Of course, there is no provision to report losses and offsetting of the losses with any other incomes. But in case you are having a profit, you need to report that particular profit in that schedule. What happens to the TDS? I have a net loss, so I don't have to pay tax on the online winnings that I have made in the entire year on a consolidation basis. But in the first 2 quarters, there is a tax being deducted, and in my form 26AS, there is a 40,000 credit and a 12,000 TDS. What should I do in such scenarios? There is no, if we do not disclose that income anywhere, we cannot claim corresponding TDS. So as of now, the only option available to the assessee is to report that 40,000 as the profit earned from online games and claim the 12,000 TDS back. So that is the only option available as of now. But technically,
refund
will not be there because the tax will be 12,000. Corresponding TDS will be there, and accordingly the tax payable and TDS will have a 1-to-1 matching. Just that TDS cannot be refunded because the assessee has claimed a loss on a yearly basis, but 12,000 is another additional loss that the assessee will have to bear. So that is something which we are expecting as a change in the income tax utility. We have to actually make it like a capital gain schedule itself. date-wise reporting of profit and losses should actually come up in the near future. But as of now, the only option available is to report that 40,000 as a profit and adjust the TDS against that particular profit.
But then again, it
There
depends upon
is
the
a
existing.
mismatch.
Sorry?
Income is there 40,000 rupees, there is after 4,000 or something like that.
No, in this case there will be a match.
Quarterly basis you are giving.
Correct. So income will be 40,000. Under TDS schedule also income will be 40,000. So there will be a one-to-one matching and TDS also can be claimed but not refunded. So on 40,000 there will be a tax liability of 12,000.
There will be a
TDS of 12,000 and we don't have to pay any further taxes.
Of course, but the income tax they will say and return is the assets. Then they will say there is
Mismatch of income, and then they may ask for queries and details.
But technically I am reporting more. In case I have, in fact I have a loss of 10,000, but I am reporting 40,000 as my income. So there should not be any such issues is what I feel. In reality I have 10,000 loss, but because of this 26 years mismatch I am reporting 40,000 income. So this is like an additional disclosure. We are ignoring the loss.
They will accept it.
Yes. The other scenario they may not accept. Suppose if we leave the entire schedule just because we have a loss, they will issue an intimation saying you have earned 40,000 profit but you have not disclosed in the income tax return. So the other way around is possible. But when there is a loss, we have to technically ignore the losses.
If the loss is more, then I think it's better to ignore TDS.
Yes, that is also possible. If the loss is so huge that you can't bear any more losses, you can ignore the entire row in the TDS schedule and
It's not a reality now.
not yet. We have to still see how it changes. At least they have brought in a new section because we have had assessments going on for AY 22-23, wherein the gross winnings are 2 crores. This is a real life example I'm quoting. The SSC has a 2 crore gross winnings, but the buying deposit is 2 crore 25 lakhs. So he actually has a loss of 25 lakhs. Only because this new provision was not there and there was no other mechanism to disclose how this online game profits were there. The department has treated the 2 crore as the income, and because there is a provision in 57, barring the SSC to claim expenses against 56 lottery incomes, they have not given effect to 2 crore 25 lakh expense, and the SSC we are still fighting in the upgrade forms. So at least it's a good step that a new section is introduced to address those issues, but still these procedural issues are still there. That also could be addressed in the coming future. Rebate under section 87A, we have had lengthy discussion last year, and ultimately Madam has made sure it's very clear that rebate is available only on incomes other than special incomes in case you are opting for new tax regime. So only if you are opting for old tax regime, on the entire total income you get the option of availing rebate under 87A. If you are opting for new tax regime, rebate will be available only on incomes other than special incomes. So that is something which is made very clear in the budget. So there are few small points that I have made which will help us in filing returns in a better way, so that we'll be mindful of a few things. This 5-10 minutes we'll discuss this and we'll open for questions. AIS and 26 days information is very important, particularly given the current scenario where we are receiving lots and lots of 143.2 notices and 148 notices that are being issued by NFAC. So given that scenario, we need to have one round of check between the income tax return and the information that is recorded in 26 A's and AIS. If the client is okay, it is always okay to disclose more. If the AIS is showing more, please disclose that more. If the SSC has more income, disclose more than the AIS. So that is something that we can follow as a policy, so that there won't be any issues in the future. Like I mentioned earlier, AIS is only there to support the SSC in preparing the income tax return. Ultimately, the true and correctness of the return is SSC's responsibility. Unlike our audit reports which are true and fair, ITR forms are always true and correct. There can't be any opinion there. There can't be 80%, 90%, there can't be materiality. 100% it has to be proven correct. So therefore it's pertinent to make sure proper disclosures are being made, and AIS information is used only as a supplement to the ITR form and not the final source for determining how much is the income for that year. TDS claims we have to match with the corresponding incomes that are being offered. In case there is a income that is not being offered and deferred to the subsequent assessment year, there has to be a clear mention as to this income is not offered and what is claimed in that particular assessment year, what is not claimed in that particular assessment year will be carried forward to the next year when the actual income is being earned by the assessee and disclosed in the respective schedule. Verification of ITR, we don't have 120 days now. It's been 2 years since the 30-day rule is in place. So we need to verify the return within 30 days of filing. Otherwise, the date of verification will become the deemed date of filing the return, and other complications of 134, 139F, 139.4 and 234F, all those things will follow. Aadhaar OTP is mandatory now to register any PAN on the portal. Before it was not mandatory. Now whenever you are registering a PAN on the income tax e-filing portal, you need to enter the Aadhaar number. It should be linked with Aadhaar. If it is not linked, you have to first link the Aadhaar and then come back to registration, and the OTP will be sent to the number registered with Aadhaar, and only upon verification of the OTP we will be able to get the PAN registered on the portal. Interest earned on post office deposits is very important. All these years we used to get this as an interest from deposits in AIS SFT information. But this year surprisingly it is appearing as interest others. So please make sure you check for interest others as well apart from interest from deposits, because this is a slight change in the SFT reporting that has happened in this year. Only from post office, if you have earned any interest, check for interest others, you will get the interest from deposits held in post office over there. Pre-validation of bank account is mandatory. Like I said, we can choose multiple bank accounts in the ITR. However, the CPC will choose one of the accounts which is pre-validated on the portal to process the refunds to that particular account. Respond to any outstanding demand, extremely important. We have seen many cases where the assessees have faced issues with getting refunds credited to their accounts because of some unnecessary outstanding demand that is still lying on the income tax portal. So it is very important to check whether there is any outstanding demand which is appearing on the portal. If the demand pertains to the assessee, then we may have to seek alternate measures to reduce the demand. If it does not pertain to the assessee, make a clear representation there. You can submit your response to say that this does not pertain to me, and if possible we may have to meet the assessing officer to get the demand nullified or get the demand deleted so that the refunds will be processed to the bank accounts. Schedule FA is extremely important. Somebody was asking about ESOPs and RSUs disclosures. So, these days it has become quite common to allot shares of a foreign company to the Indian employees. So always ask these employees whether there's a small check that you can do. In Form 16 we'll have salary under 71, 72, 73. So just check under the head perquisites, is there any disclosure of sweaty equity shares? So if there is any disclosure of sweaty equity shares, and if the company which the assessee or employee is working is a subsidiary or a branch of a multinational corporation, we have to make sure to ask the client as to if they are getting any allotment of RSUs, are they getting any allotment of ESPPs, are they getting any dividend income from those shares that are held abroad. So these questions are very important to ask the clients. Nevertheless, even if that is not there, it is always convenient to ask the client, do you have any foreign assets, do you have any ESOP allotments that are being made? Because Schedule FA, although the penalties under Black Money Act have been reduced in the past 2-3 years, but still it's a flat penalty of 10 lakhs. It's not based on the quantum of non-disclosure. So it's always better to disclose rather than face consequences of Black Money Act. Check and verify the details of previous ITR, especially in cases where the client is coming to you for the first time. It is always important to ask for the documents of earlier filings in order to do a one-to-one mapping. Suppose you have some brought forward losses to be offset in the current year. It is important to see whether those losses were reported in the last year, how much was the loss reported, so that some sort of calculation mismatches will be avoided. Also, you should see whether returns of the past years have been revised. It may so happen that the client has come to us for last year's filing, we have filed the return. Subsequently, the assessee might have gone to somebody and got their return revised. We have the data of the return which we have filed originally, but the assessee has filed some revised return or some ITR U has been filed for any of the past 3-4 years. So these are the small checks that we need to do to make sure the cascading effect of reporting in those returns will not have major impact in the current year's filing. Directors details and the details of shareholding. Again, it's mandatory in ITR 2 and 3. You have to select whether the assessee is a director in any company or holding shares. So it is important to disclose the shares and directorship in the respective schedules. Filing relevant forms is extremely important to claim certain deductions or exemptions. For example, 10 IEA is very important to opt out of the new tax regime in case of ITR 3 and 4. 10 IEA is important for 10 80DD and 80U deductions. 10E for claiming relief under 89. 67 for claiming FTC, so on and so forth. There are few forms which are mandatory for CPC to process a particular deduction. Suppose you have claimed relief under section 90, the CPC will automatically look for form 67 in the portal. If there is no form 67 found on the portal, CPC will directly deny the relief under section 90 and we may have to take the recourse of the appellate forums to get the relief of that FTC. So we have to make sure if there is any form that is required to be filed in order to claim any deduction or exemption or a special feature in the Act, we make sure that the relevant forms are filed and the relevant forms are downloaded from the portal along with the ERNs and all those things are well in place. So these are the things I found are little important while we file the returns, because in a hurry we might miss out on a few things, especially the back end of the season where the clients are coming at the last minute and the time, we don't have much time to file so many returns. We may miss out on a few things, so it's important for us to check these points to make sure the client does not come back with a 143 notice. So that is something that we need to make sure. We can open up for questions. If you have any questions on any of the topics we have discussed, we will spend 10-15 minutes on questions.
Case of practical things.
Yes, sir.
Seller, there are 6 people sellers.
Okay.
6 associates are there.
6 assessors are there, and consideration is about 72 lakhs.
Okay.
And when you put the buyer's details and all that, we are putting the details, and amount is coming only 12 lakhs, not 72 lakhs.
Amount
because
total
consideration is coming only 12 lakhs. Then what will happen for other associates who may not file the return?
So in this case, you are telling the assessee's share of consideration is 12 lakhs.
That is only coming
12 lakhs. Our responsibility is restricted to that 12 lakhs.
Yeah.
So other assessees, they technically have to report this capital gain, but the reporting requirement of that particular assessee is restricted to 12 lakhs. Which we can just report 12 lakhs because that is the share of capital. That is the share of consideration that the assessee has.
I have a small doubt, and this doubt is pertaining to section 28 you just referred earlier slide, where you said now house property residential income from the let out of the house property is treated as a house property income and not as PGBP. Okay, now I have a client which is a company, and this company is into only giving letting out of the properties of residential house property only, not an individual, neither an HUF. It's a company only, formed only for that purpose. MOA, everything is in accordingly. And all these years we have been doing, taxing them under section, of course, PGBP, which is the charging section 28. Now, how do we show this as a house property?
Going forward, we have to show it as house property. Of course, we can't do anything for the earlier years. We have Chennai Investment Properties decision where the company was formed merely to construct properties and give it out on rent. So based on that judgment, all these years we are paying it as PGBP. But going forward, because there is an amendment in the law itself for residential properties, going forward we have to offer residential properties under house property, commercial under PGBP. That is possible.
If there is any other minor income, then in case this depreciation and everything disallowed in that case unnecessary
Correct.
payment.
All those consequences.
English plus the loophole of the short-term renting, which were earlier people were trying to put it in the business income.
Correct.
Short-term renting, it was put under the business income. Some people, it is not fair also. Now there is a clear clarity that you have to show it as when there is a residential unit, you are letting out for short-term, like Airbnb or other online platforms, OTT platforms. It has to be rental income only. Thereby, more portion is coming for the taxation.
We need to be mindful of the expenses as well. Because under section 37 we can claim expenses insofar as it pertains to income we have offered under 28. So there is a separate schedule in the income tax return also to exclude the expenses from PGBP or rather from the P&L account against an income which is offered under any other head of income. So it's in case you have incurred expenses with respect to those maintenance of those residential plots or residential properties, those expenses also need to be carved out from PGBP because the only expense that is allowed is the 30% standard deduction. So apart from that, nothing is allowed.
Otherwise, you have to convert it as a commercial property, commercial taxes you have to pay, and then you have to claim on the expenses, business expenses. And then it will not be a residential area.
Because that is an accommodation that we can do, but
GST you have to pay.
yes, that will have other consequences.
Out of 4480, there is a for professional firms available.
Therefore, in my view, I don't think it's permissible.
So of course
It's
GST
again litigatable.
GST on residential property is not there. Anyways,
You cannot have the cake as well as you are eating.
Yeah.
So what they have done is, either you go for full commercial and you claim a business income. If you say it is a residential unit, pay the rental income as a taxes, not as a business income. Because you will claim 6% as the profit. Then it is wrong.
No, she's not in the residential taxation. No,
Business income.
Basically, in my view, they are restricting the claim of expenses, which is why, because otherwise, you will put everything direct remuneration or all those things you put against profits. Exactly. So all those things will be there. Which is why.
Sir, I got one question here. So one of my clients, he is working in a senior position in Indian company, and the company has opened 100% subsidiary in South Africa.
South Africa.
Yeah.
Okay.
And the gentleman has been appointed as a director in that company. But
In the South African.
Yeah, in South African company, but he don't hold any shares, and he don't have Indian DIN also.
Okay.
Then he has to declare as he is a director in the ITR return.
Declare as a director, no, because this is directorship in Indian companies. Yes, Indian companies, not directorship in foreign companies. If he has any other equity interest or anything in that company, of course it comes as a part of schedule effect. But as far as directorship is concerned, we have to disclose only Indian.
Sir, continuing this rental income discussion, there is a concept of deemed rent under section 24.
Correct.
23-24. So now, though the property is not let out, this deemed income will come under taxation.
Correct. Under house property.
Under house property.
So that is applicable for real estate developers where the business is buying and selling of plots. So if the business is buying and selling of residential units or any other units, the time limit given for vacancy is 2 years. Beyond 2 years, the fair value of the rental income of that particular property will be deemed to be income of the.
I am talking about now this residential house property is being taxed under house property income. So now this residential house property, when it's taxed under house property income, it's a residential unit which is vacant. Earlier when it was business income, there was no tax.
No tax.
Because no income was earned.
Correct.
Now when it is coming under this particular category, what is happening is, though he is not earned any income, he has to pay tax, deemed to be let out.
But they claim interest paid.
Interest paid was anyways allowed. Either under 24B or 36.
No, I am talking about the income part.
Yes, these are more income part. Yes, deemed let out provisions will be applicable.
Yeah.
Yes.
But 30% deductions as usual.
Yeah, 30% is standard deduction. So they have restricted the expenses to 30% basically.
Now this thing is not applicable to a builder.
Builder,
It is applicable to
if the builder is into business of constructing and letting out of business of commercial properties, then it is PGBP. If it is residential properties, it will be income from house property. If it is a builder who just builds and sells the plots, there is a time limit of 2 years. So under 23(5), if I am a builder, I buy plots, then construct the building and sell those flats, I have a time limit of 2 years from the completion certificate to show my value as nil. But beyond 2 years, the fair value of rental income from that property is still treated as income from house property.
So builder there is a 2 year.
2 years window is there only for the persons who are buying and selling properties, not for the ones who are into the business of giving it on rent. If you are giving it on rent from day one, you have to offer it under house property.
So deemed to be let out
Is applicable, yes.
Hello, sir.
Yes, sir.
Sir, husband and wife are the directors of the company. There is a family-owned company, and the director wants to claim books the remuneration as 20 lakhs as a salary for her. So, can we claim go under 192 for that TDS and all?
Yes, we can do, sir. 192 TDS is applicable for directors who are on employment basis. If the director is on a contract basis, it comes under 194J as professional fee.
Correct. See, this is husband and wife company.
You can claim it under 192.
192, and they have filed that MRN form and all the company compliance and all.
That is companies.
Okay. And sir, another thing is that
of course, this is subject to 40B. So if in case for a similar position, for an outsider you are paying lesser salary, only because it is a related party if you are paying more, you will be subject to 40B. Subject to 40B.
40B is partnership for this thing, right?
40A2B, sorry. 40A2B gives us the restriction on payment to related parties.
Okay.
So this provision is subject to that 40A2B.
So then in the course of IT filing and all, who will decide that?
IT filing, 40A2B is not applicable. 40A2B is applicable
No,
only if the assessing officer is of the opinion.
Yeah, it depends on the assessing officer.
Depends on you.
So just we have to report
Yes. As far as ITR filing or Form 3 is concerned, there is no responsibility.
Sir, another question, sir, in the company's angle there. So he's rest of the employees are paid more nominal salaries, and the director pays 20 lakhs. And another thing is that another 3-4 lakhs. Now in the next year they're coming with the insurance, like somewhat like Keyman insurance. Not actually the Keyman insurance. It's entirely only for that lady. They have been paying 4 lakhs or 5 lakhs in insurance, which they want to claim as an expense. So because earlier in another company they have done that, it's of the assumption of that director of that kind, which I am initially obstructing that. So because you are only targeting your profits to come down only to what is that? Personal movement, you know.
Okay.
So whether that will is there for that.
It's have two implications. One, disallowance for the company.
Correct.
One, there will be a tax on the director as well under 1724. So the obligation of the employee to be paid by the employer, irrespective of the allowance in the company, the employee also has to pay tax on that. So not just the company will have disallowance, because it is a personal expense of the director, the employee also will have a consequence of double taxation.
But they want to claim as an expense in the books of
That is not allowed. That is not allowed. Personal expenses are not allowed.
Sir, the umbrella what they are doing is I even talked to the insurance company and all, they are telling that it's a insurance, group insurance schemes only like.
Group insurance?
But they are not including the other employees. So you understand what I'm saying? That is how things are working there. So I obstructed the insurance company and all, the insurance company said, so all these things are happening, not many companies, you are the one who was criticizing that.
Group insurance again is a separate thing. This is just bending the law without breaking, that's what I can say.
So, PTC section, receiving the less consideration, then the stamp is there.
Correct.
So, we have to take stamp duty at less consideration.
Correct.
So, any 10% increase like that is there?
No, there is no change in that.
No change.
There is no change. The tolerance band is still 10%.
Still 10%. So, last to us.
No, nothing as such.
Sir, as regards this rental income property, this PGBP is allowed only for builders, or what it happens, so in case if there is a buyer who has bought a commercial property per se, is bought only a commercial property, and it's a PG, and is running a PG business, along with though along with he being a owner of the property, he is side by side running the PG business. So thus collection of that PG fee, whatever he collects from whoever is going to stay as the guest, PG guest, does it become house property or PGPP? How does it become?
So PG is technically for residential purposes. We have to see the exact amendments.
It is kind of like 50-50. The property is like 50%.
Commercial or semi-commercial, because it is given with the food and other things. Residential units, you should be renting it out only for the serviced accommodation kind of a thing, where you don't serve the food, you don't give the other facilities, swimming pool and other things. Then it becomes a pure residential unit.
So in this case, then maybe it will become commercial itself.
Yeah, once they become commercial, there are other intricacies also. Like maybe you will say that only if it is in commercial area it is allowed. Residential area it cannot be allowed.
All this electricity connection and all that will happen.
Electricity connection has to be commercial. Trade license has to be taken. If all the compliances are done, then that is what people are doing. Income tax 6%. You understand? 6% of the turnover is treated as income and pay the low tax turnover. And in other cases, they will say that it is not a commercial.
Not commercial. So in order to tackle the commercial taxes department, they say it's residential.
Yeah, because
or tackle income tax.
GST also comes into picture. Once it is commercial, GST tax is applicable.
So it could be treated as commercial itself is what is the controversy.
Sir, regarding this PG properties, there is a Madras High Court decision in GST case where it was held as a residential property. Now, if they take up that Madras High Court decision, whether that GST decision will be applicable in income tax scenario?
No, sir.
Because the moment they say it's a residential house property, there is no GST on it.
Okay.
When the court has interpreted that this kind of property will be treated as a residential unit, whether income tax, whether the assessing
there is no provision for importing the interpretation of definition. There is a clear-cut Supreme Court judgment in Venkateswara Hatcheries. It says that even if the courts have interpreted a particular provision for a particular enactment, the same definition or the interpretation cannot be imported to another enactment. So even if the GST department or the courts in GST have held it to be a residential unit, the interpretation should independently be checked for income tax purposes. Is what I mean.
The decision.
Only planning possible is they have to hive off the food dealing to the third party, and residential renting should be okay.
That could be done as an account.
Yeah, foods are supplied by third party. Like wife will be supplying the food, husband will be giving the renting.
I think it's time we will close the forum for questions. Of course, if any further discussion needs to be made, we can do it now. Thank you so much. Thanks. We had a similar session last year as well, and it was pleasure coming here again for this wonderful discussion. It was nice interacting with you all. Thank you so much.
Thank you, sir. I would like to express my heartfelt gratitude to CA Karthik for his insightful and enlightening presentation on the recent development in ITR forms and important income tax updates applicable for the assessment year 2025-26. The depth of knowledge and clarity with which he addressed these complex topics has significantly enhanced our understanding. We appreciate the time and effort he has dedicated to sharing his valuable information with us. Now it is my honor to invite CA Pramod sir, the Regional Council member of SIRC, to come forward and present the token of appreciation and gratitude to CA Karthik on behalf of Bengaluru branch and members present here. Thank you, sir. Happy CA Day in advance. Tomorrow we are organizing walkathon on account of 77th CA Day, starting from Vidhan Sauda to ICA Bhavan at 6:30 a.m. followed by breakfast. flag hoist, blood donation camp and eye testing camp. See you all tomorrow at 6:30 a.m. Thank you one and all. I'm Sri Raksha, MC member signing off. Thank you.